course. Yeah. See you next week, Kenzo. And guys, next we're going to bring in the old favorite from the channel, Chris Pulver. I'm going to run a quick ad, and then he'll take over the show. So we're going to run the ad, and we'll be back in just about 30 seconds.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8Cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8Cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Hey everybody, happy Friday. Good morning, good morning. Happy to host here with A1 Trading. This is Chris Pulver. Usually I run my session here 9 o'clock for the Pulver Report and jump on in at 10 o'clock or so with Nick and the team, but happy to be here at 9 a.m. and just kind of double up. So let's go ahead and dive into everything. I'll start from the top down to do what I usually do, which is dollar, oil, gold, silver, Bitcoin, Ethereum, ETFs, indexes, dive into some currencies, some individual stocks. I just pinged Frank, see if he wants to jump in and join me at all. We had some big moves this week in earnings. We had plenty of stocks this week. Even though it was a very kind of mild earnings week with only about 103 companies, we had a lot of moves this week that went well over expectations. So that's a good thing if you're long the option. It's a bad thing if you're short the option. So if you're trying to put strangles in, or you're trying to pin these prices with these butterflies, the expected moves, some of these stocks have blown out these expected moves. So we'll talk all about that. So let's start off with the dollar index. Dollar index, the basket that refuses to give us any clear direction. Currency strength for today. We have the New Zealand dollar on top, the Aussie on top, Euro, CAD just got a little bit weaker. Bank of Canada, I just saw this real-time news in my Discord feed. The markets are pricing in about an 80% chance instead of a 66% chance that the Bank of Canada is going to cut in June. If you are paying attention to this, I know Nick is out of town through the week. I myself will be out of town next week as well. But it's a week that I certainly want to be watching some Forex trades. I want to be watching, setting chart alarms, of course, and be aware of what's going on. Next week, we have some interesting news. We have PMI numbers coming out early in the week. We have Swiss CPI numbers coming out as well on Tuesday. We have job openings for the U.S. on Tuesday. And we get into some central bank rate decision. We have Wednesday, BOC. Right now, there's no forecast. It's going to be interesting to see what happens next week if the market is anticipating a 25 basis points cut, possibly a 50 basis points cut. We'll find out. Let's see what happens on Sunday, Monday with this calendar updating. Let me see if there's a forecast in here right now. I'm pretty sure there's not. So there's no forecasts. And I'm starting to see this more and more. You're not getting any forecasts until the week of. So it's like all these economists and all these calendars are playing it close to the vest, and you're not really getting this until the week of. And so we just get short-term reactions, and sometimes nothing happens until we have a big slew of news like we have next week. This week overall has been pretty quiet. Futures is up. Markets are tilted higher. Pre-market, the ETFs are higher. So we broke last week's low with NVIDIA. We broke yesterday's low and sold off a couple of dollars. We had some gaps to the downside. Pressure remains to the downside today, but it's a Friday. Typically, Thursdays, Fridays form highs for the week. I'm curious to see if the market claws back, or we have a gap open today, and then the market fills and fades to the downside, puts a little bit more pressure towards the bearish side today. But we'll find out. I've got some levels I'm watching. The SPY would be around 520 to 519. I'd like to see if we can get there today. However, if we get an open around 524, 525, that would be basically opening and quickly filling that gap at the downside. So not sure if that's going to happen, but I'll be watching until closing bell. So back to the calendar here. Bank of Canada on Wednesday, as I said, 9:45 a.m. Eastern time with a press conference after at 10:30. If they cut rates, this is what I've been saying to my traders for the last month or so. I would expect there's going to be 3 potential dovish banks going into the summer. That would be the Bank of Canada, BOC. That would be the European Central Bank, ECB, and the Bank of England. Those 3, to me, in my opinion, would be the 3 that are likely to cut prior to the Fed, whenever the Fed wants to move this year. Maybe they cut, maybe they don't. It'll be a wait and see. I had some followers of my Discord yesterday post, the Fed's going to cut in 2024. And the Fed doesn't matter. I mean, the Fed's going to cut if they're going to cut, or they're not going to cut. We will know when it happens. And the reality is the market can change this all the time. This Fed watch tool has never been wrong. Okay, I'm putting that like in air quotes. It's never been wrong leading up to the actual rate decision on the Wednesday FOMCs that we have. But the problem is it can literally change all the way up to that day. So it's never wrong because it changes the entire time until it finally gets it right the day of FOMC. So what a tool, So anyway, the watch tool, let's take a look at that really quickly. Let me finish up on the calendar. So we have BOC on Wednesday. Are they going to cut rates? We'll find out. We have ECB on Thursday. Are they going to cut rates? We'll find out. The main cash rate for the ECB is 4.5. There has been the rumor mill swirling on a 25 basis points cut. If that's the case, that would be around 8:15 a.m. Thursday. There's a press conference with Christine Lagarde on Thursday morning as well, 8:45. No offense to Christine Lagarde, but I have to say it's not nearly as dramatic as it used to be for all those years trading Mario Draghi. Oh my gosh. Has anybody been trading Forex for more than, a couple of years? If we have any like 3, 5, 7, 10-year traders out there, if you've been in the Forex market, Mario Draghi's a name you should know well. Man, that guy's created so many wild and crazy, awesome trading days in Forex on the Euro with these ECB press conferences. I miss him a little bit. I miss a little bit of that volatility, but it's okay. I'm just sitting in Swiss pairs anyway, right? And then Friday, we have non-farm payroll with the U.S. and CAD. So a double whammy of employment news, average hourly earnings, non-farm payroll, unemployment rate for the U.S., unemployment, and job numbers for the Canada economists. We'll see if there's a big hit or miss. 175 was previous. There's not even a forecast going into next week. So again, as you come into trading on Sunday night, if you're a Forex trader or come into trading Monday morning to kick off the week, look to see where these forecasts are at. I'm curious what the expectations are printing around for the U.S. job numbers on Friday. Of course, I'm curious to see if the market is forecasting a rate cut. If so, that'll be the first real policy shift we've seen in over, I want to say like 14 to 18 months. Once we came off of these crazy lows, so central banks essentially went from this. Okay, this is our bell curve of positive interest rates to negative interest rates. Okay, so every central bank from positive interest rate territory slashed rates during COVID in 2020, emergency cuts, right? And then that policy started to shift aggressively when we had to battle inflation, shift back up. So everyone went from effectively 0% to 3, 3.5, 4, 4.5, 5+% interest rates, and everyone's sitting right up here. The only bank that has cut, we had the Bank of Japan, which was still in negative territory, that has now shifted into fractionally positive territory. They're probably standing right there at 0 to 0.10. We have the Swiss National Bank that has cut rates to 1.5. We have the ECB currently sitting at 4.5. We have the Bank of Canada at 5%. We have the RBNZ, the New Zealand dollar, Reserve Bank of New Zealand at 5.5. We have the RBA at the Reserve Bank of Australia at 4.35, and we have the pound at 5%, I believe, 5.25. Let me check this website, cbrates.com, just to verify, make sure I remember all these. So we have Canada at 5%, Eurozone at 4.5, Japan off the negative interest rates to flat, fraction of 1%, New Zealand at 5.5, United Kingdom 5.25, US 5.25, 5.5, Switzerland cut rates in March to 1.5, and I'm curious, of course, around. Switzerland, again, if their inflation numbers are improving, are they going to continue to cut rates and maybe slide down to 1.25 as other central banks cut as well? So one of my bigger trades this year is long the Swiss. It's a positive swap trade for me. Aussie, CAD, Euro, Pound, Swiss, or New Zealand dollar against the Swiss. It's worked out really well. I'm sitting on a bunch of pips. I'm still riding those winners. That's, to me, that's the carry trade that I enjoy trading. I saw Kenzo was on talking a lot about the yen. I'm very open and honest when it comes to trading the yen. Be careful, trade small. When the yen basket wants to move, it'll be amazing. If we see a big strengthening of the yen, we're going to see an entire market deleverage. That's the scary part, is everyone that wants to see a stronger yen, you don't really want to see the peripheral consequences that come with that. Because if we see a stronger yen, that is an entire tsunami of risk-off trading. And that's going to come with a horrible plunge in equities. That's going to come with a horrible plunge in risk-off trading. Everything around that could be very, very damaged. So you kind of want to see, if you want this bull market to continue, and this has been a bit easier to trade than being in this wild, sloppy, volatile bear market. A bull market's pretty easy to trade. Bulls climb stairs, and the market looks for any reason and latches on any reason just to keep gaining, right? So this week, with a lack of news, what did the market really cling to this week? Well, we're still kind of in the NVIDIA hangover phase, where this is the NVIDIA candle where we had a sell-off last week on Thursday. The weekly candle thus far is red, which is why I have this big shaded zone red. Now, we sat here yesterday with the low around 521. I was looking at the gamma level at 520 to get hit. Possibly it gets hit today. One thing that I'll be watching for today's intraday price action is if we do not take out yesterday's high, then there's a chance we can open and then fade back down to yesterday's close. If there's a little bit more pressure to the downside, I still see a lot of levels, open interest levels, gamma levels at 520 and 519. So if I get that level hit today, I'll actually turn a nice little profit on a 523 long put. If it stays where it is, I'll lose my $1.20 that I took yesterday, but I make up for that for $1.40 in Alta, which was a little earnings play that I did this week. You possibly saw me take the trade with Frank earlier in the sessions this week. So my trading room wise this week, we did pretty well. CRM, I played it light this week. I didn't do anything crazy with it, the typical earnings that I normally jump into. Alta looking to get full credit today for $1.40. That'll be a nice little win. I'm already claiming it because we've had a huge move to the upside. The stock would have to drop about $40 today intraday, which I don't see happening. So that should expire full profit. I don't have to close that out for a partial. And then CRM was Salesforce. We had a big whiff in Salesforce. I paid a lot for that debit. That was $14.59, but ended up closing out near max profit 2 weeks before expiration for about $22.15. My max profit was $22.50. So obviously I wish that, oh man, I could have put it up to $25 and $30 for my sell side of the trade. But that would have made for probably a $15, $16, $17 debit, and the expected move was around $18. So I played it the right way. I planned for a $17, $18 move. We got more than expected. So I'm not being greedy here, but overall pretty darn good. I did a video this week for I was doing this for anyone that's in my trading rooms or anyone that's interested in my trading rooms. We've collected like over $850 of credit between my equities on demand and Delta Trader course in the last couple of years. So we've done pretty well. 61% win rate in equities on demand, 69% win rate in Delta Trader. That's earnings, that's short term, that's 0 to 14 days to expiration type trades. And then longer term, portfolio, we've had some repairs, and it's still, 61% is pretty solid, makes me money. 69% is pretty solid, makes me money. So no complaints on that front. I'll check and see how the robots did for me this week as well. I usually throw that in for my blog on Fridays. I'm guessing they did just fine because they usually do. But let's go back to the chart. So we finished up the calendar. We're talking dollar. I really don't love what the dollar's doing right now, but the nice thing is after next week, we have non-farm payroll. The week after that, we have CPI data for the U.S. and we have the Fed. The June Fed meeting should be pretty important. All right. And the reason why it should be important is because I would like to think that the Fed wants to set the tone and really give the market some clarity. Now, the Fed's all about transparency, okay? But that transparency is almost oversharing the same information every month, which is right now, this is what the Fed says. We'll raise rates if we have to. We'll cut rates if we have to. We're higher for longer. That sounds familiar, right? It comes from Powell. It comes from every Fed speaker you see in the news when they're sprinkled in all week. They all say the same thing. They're all talking out of both sides of the mouth. Nobody really knows what's going to happen until it happens. And that's what sucks. But I look at the dollar and I'm still torn between what does this dollar want to do? And I keep going back to this and I sound like a broken record, but I have no good trade on the dollar right now. I can't get a good vibe or a good direction from what the dollar wants to do. That being said, I am mixed on my dollar crosses. I'm long dollar CAD. I'm long dollar Swiss. I'm long New Zealand dollar, which is doing well. The pound, I think, has taken a turn The pound was weaker. Now it's up a little bit. My pound dollar is still active right now. My New Zealand dollar is taking off to the upside, which is nice. Did we close that one yesterday? Don't tell me I closed it yesterday. Did I close it yesterday? I think I did. I did yesterday. I closed it yesterday for like a 10 pip loss. You dummy. Well, I mean, I'm going to be out of town next week, and so I closed up some. Yep, I took a 12 pip loss in New Zealand dollar. F&A cotton. All right, so New Zealand dollar took a small loss, took some wins. Pound CAD, pound Aussie, Euro New Zealand had some wins. Robots, I'm sure, did pretty well this week. I'll take a look at that. But I just don't get a good sense of direction, right? That being said, we should see the dollar decide to do something a little bit more constructive than what it's been doing for the last couple of weeks. Okay. Very little direction here. I'm sitting here at a trend line. I would expect to see that this technical support is available to see the dollar get stronger. But here's the trade-off. Okay. If the dollar gets stronger, okay, let's say that we have a big, high, like the forecast is 200K for non-farm and it comes in at 300K. Does the market like that or not? Well, that means hotter labor market. That means a tighter job market. Maybe the market doesn't like that, right? That puts the pressure on higher for longer. So maybe that happens. Well, if the dollar gets stronger, that's typically risk off for the stock market. I think the best way for the market to continue to go higher, okay, for the broad market to go higher, we should see a weaker dollar. That doesn't mean it has to happen. In fact, if I want to see a weaker dollar, I'd love for it to be up here so I can actually plan on a bigger swing and a bigger, kind of a quarter or several months of dollar weakness, as opposed to, do we get it for a week? Do we get it for a week or two and that's it? I'd like to see a bit more of a kind of a fundamentally driven, weaker dollar instead of just all this chop we've been dealing with the last couple of weeks and even the last couple of months. It's been a tough basket to predict. So we have non-farm payroll next Friday. We have CPI plus FOMC the week after that. I would like to think the dollar can make a decision. Now, to be safe on this, I think the dollar bulls have to take out this high around 105.55. I think the dollar bears have to take out this low around 103.90. Okay? If price stays in the middle, I'm not that interested in the dollar. If price actually shows the confirmation break one way or the other, I'm going to try to follow that flow for a little bit and see if the dollar basket will cooperate, right? This is a good thing. As a trader that has a slightly bullish tilt to my portfolio, if the dollar gets weaker, my stocks, my equities, my options, my everything that I have a bullish tilt towards should be doing pretty well. Okay? So if that happens, great. Everything else goes up. Risk on trading, cool. Let's see what happens with oil. Let's see what happens with gold and silver. A weaker dollar probably boosts a lot of things. So for the broader market to stay bullish, dollar's probably better off getting weaker. Does that mean it happens? No, but we'll watch. So like I said, I'm eyeing the big levels here. 103.90 to the downside, 105.50 to the upside, and that's where I'm looking to play the dollar. Okay. If we go to oil, I thought about this morning. I mean, it's essentially it's a stab if you want to take a trade on oil. Right now, I mean, a couple of things, right? We're coming off of this swing to the upside. We've had a pullback. We've had some stability here. If you took a very short-term stab at oil, long here, stop loss below, look to see if we head higher. Now, I don't know if that's the right play. We're in the middle. Bulls and bears can fight all the time in the middle. It's easier to be a seller high, and it's easier to be a buyer low. It is way more challenging and difficult to trade and get a good sense of direction when price is in the middle of everything. So do I want to force a trade on oil? No, not really. But if I took the trade, why would I take this trade? Well, we've stabilized here around $78, $77. We're not going much lower. We are breaking this little trend line. So this is resistance. We're breaking that trend line. As long as we hold this trend line break, stop loss there. And if we want to continue where this trend started from, these lows, then we look at this low to high swing, pullback, and we're looking to finish that move up towards the 90s. Now, again, we know there's ramifications for higher oil prices. That's going to make inflation stickier. That's going to bring commodity prices up. That's going to be a weaker dollar, right? Or commodity prices up versus the dollar. There's obviously conflict and geopolitical tensions when it comes to oil prices and supply and demand. So there's a lot riding on a big oil move. There's also like tranquility in the markets and low volatility in the markets when oil doesn't do much. which is kind of what we've seen, right? If you watch any type of implied volatility, it's been extremely low, right? Even this week in the VIX, I mean, from last week's NVIDIA sell-off, the VIX has only moved, I mean, it's moved about 15 to 20% off of some fresh lows. We haven't seen lows like this since like 2017. We moved up around 29% this week on the VIX, but not really that notable to me. I have a long call out to August. I'm basically playing like a pretty inexpensive hedge. If I'm right, I'm trying to turn this into, if price hits, $16, $17, I'll flip it for a couple of dollars and make some profit. If we have a bigger spike up towards 20, I'll flip it for, hopefully $5 or $6, or probably $4 or $5 profit. But that's out there to August, and I'll see if the market gets excited about anything other than trying to go higher. Okay, so we did dollar, we did oil. Let's go gold and silver. Gold is $23.54. As I had mentioned, you got to watch out for this little structure at the top. This could be a broadening pattern. This is high volatility. I just saw a tweet this morning that silver's had so much volatility the last couple of weeks with these, these 1 to 2% swings. That would be the equivalent of the SPX or the S&P 500 moving over 1,000 points a day, right? Is that happening? No, but it's happening in silver. So gold and silver remain pretty volatile. Now, I still think there's upside potential. I like gold longer-term bullish. I like silver longer-term bullish. But in order to see another move, we need to see this indecision shake out. So I think this, possibly with this recent, that's a pretty aggressive sell out there for 2 candles. So I would look at maybe a high, low, bit of a bear flag. If this continues to head lower, watch out for a bear trap broadening pattern at this 2270 support zone. I want to scoop up some more silver gold between 2270 and around 2200. Okay. I don't think we necessarily get to 2200, but if we have a swing low and a swing high and we just pull back into some retracement levels, we could pull back without taking out this low, So I have some previous levels of resistance. I've got some inefficiencies in here to hit. We look at previous lows. We look at a broadening pattern. Broadening patterns are great for bear traps. Bears come down here, bulls pick it right back up, and then we go to new highs. The nice thing is when these broadening patterns are done, they tend to go higher, right? Like if this is a bullish postured broadening pattern, this probably goes higher, and all of a sudden we're trading all-time highs and nobody knows where gold's going to stop. But until then, I would expect a little bit of chop, a little bit of volatility, a little bit of indecision. So I'm waiting to see, can I get an entry at the low and then buy it low? So I'm already in GLD at the lows. If we come back down here, I'll probably do a combination of maybe adding another tranche of shares on GLD and possibly doing a couple of bull put spreads on GLD or even some defined risk trades on gold futures. That's gold. Silver. Somebody's asking a very detailed question on the Japanese yen is because of the BOJ intervention. Well, you ask me, or you tell me. Do you like trading a currency pair that doesn't obey technically? Or if it does obey technically, it's based on an intervention that happens randomly throughout a trading week? I mean, that should drive you crazy. You can't just trade and rely on normal technicals. You're relying on a rational intervention. That's not fair, right? It's already hard enough to trade and get direction right all the time, right? So why would I trade something that's just waiting and waiting and waiting on these extreme sentiment swings or these crazy, ridiculous overbought conditions that don't matter, right? I saw overbought conditions in 2022 that went up 3,000 pips. So I just don't think the Japanese yen behaves as well as other currency pairs. Every Forex pair has its own rhythm, its own behavior, its own personality, and the Japanese yen is a little crazy. So I don't trade crazy. I trade technical. So that's why I don't like it. And I've certainly made more money by not trading the yen pairs than by trying to trade them. Now, that being said, I made a lot of money in 2008 on the Japanese yen. I made a lot of money in 2012 in the Japanese yen. But I also, I had to hedge my butt off in 2022 to not get hurt by the yen. Because I had some good technical trades that were terrible as an end result. And fortunately, I hedged and I mitigated some of the risk. But my gosh, it's like, again, classic Japanese yen that it just does nothing, and then has this ridiculous, irrational, you can't stop it, whatever it's going to do. So you're best not to fight it. Okay. So my point is, I think the Japanese yen will have great trades in the next 12 to 24 months. But the great trade to me is buying the Japanese yen at 30-year lows. Do I want to do that now and be stuck with negative swap? Not at all. I'd rather do it when volatility returns. I'd rather do it when we have this deleveraging event. I don't know when that is. You know, these markets can remain way irrational, way longer than you expect. That's the old John Maynard Keynes saying, but Japanese yen especially. And if and when we see the Japanese yen confirm all these big sell signals and confirm all this strength, it should be easy to trade. You just participate, get a bear flag, and put your stop loss to break even and watch it run 1,000 pips. That's Japanese yen trade in the next probably 1 or 2 years. Until then, everyone's in the same boat. Nikkei is at the first-time highs in 34 years. U.S. is all-time highs. It is interesting to see that the U.S. markets are at highs, and China, from lifting animal spirits over the last month or so, has really pulled back in an interesting way. So anyway, let me continue on to silver. Silver, still plugging away. Silver versus gold. Silver has been outperforming, and I hope it continues to do so. I could see a little bit of a pullback coming here. It is opening bell. That's good. We'll see where we're at. So we open up at 523. That's a fade. We were at 524.60 pre-market. Now we've been down about $1. My big levels this morning, 518 gamma levels filling up when we go real time here. Float this out. So this is what I'm watching real time. We have a resistance zone right around 525, or we could quickly fill and fade this gap. Let me see here. I bet my put option is worth nothing right now. Yep, I'm down about $80. Let me see what this is trading for right here. So SPY. So right now my $1.20 debit's trading for about 90 cents. That's not bad. I'm down 30 cents on the trade. I do want to see if price will, I'm looking at real-time gamma levels. My contracts fill up here. It's not nearly as active as it was yesterday, but I'm looking at this, 520 to 519 strike zone. If we can fade down to that level, I should be able to turn that 523 put into maybe a $2 to $3 credit. If I can, great. I'll take the profit there. That'd be a nice little flip for $1.20 to, maybe $2.50 to $3 credit. So I'll be watching that. I'll be watching that 521 strike, 520 strike, 519 strike. Those are my bigger levels in real time to see if price wants to gravitate towards those. So I'll park that, but that's what I'm watching on my other chart. Gold versus silver. Silver seems to have the upper hand right now. I like silver a lot. There's been a ton of volatility here the last couple of weeks. Okay. Lots of volatility here the last couple of weeks. But where's silver headed? I see overbought conditions with divergence. That's not a good sign for the bulls. But just like we saw in gold, this could stretch a little bit higher before we have a correction, right? This could pull back based on this high, having divergence, pulling back a little bit, wait for a trend line break, and then get long. This could also have a lot of indecision. We have a high here. We come back and test the low. We test this breakout point, and we have a push to the upside on a better buy opportunity. There's a lot of ways that price can play out. But to me, if we haven't hit this 35.67 target, this is my measured symmetry. To me, that is a profit level 1 that I'm willing to take silver to that price point. So I'm holding silver with SI, which is silver futures. I'm holding silver with SLV, which is the trust. That's iShares. Do I expect a pullback? Yeah, maybe, but I've got some puts to catch it. I've got a 29, 28, 27, 26 put. I'm collecting the credit on that. If I get a sign, great. I'll take the shares. If I don't get a sign, I'm collecting $2.29 or $3.22, depending on my number of fills, right? So if I'll have some income if I don't get filled, but if I take the assignment, I'm hoping to own it, so I don't have to play the options timing. I can just sell options around my core position, but this would go all the way up towards hopefully $44 to $45 when it's all said and done. Would I like to see an ownership price? If I can own shares at $28 or $29 and have it rally to 44, I'd be thrilled. I love it. Okay, so that's silver. Bitcoin, Ethereum. Bitcoin still remains pretty quiet. Chart alarm at 73.8 hasn't filled. Chart alarm at 56 hasn't filled. Just waiting. Ethereum's been the big news. Are we going to see an approved ETF on BlackRock and Fidelity and whatever their future Ether not futures market. We already have a futures market, but the Ethereum approved ETF, similar to what we saw in Bitcoin. You know, we saw that kind of get priced in. Things have stalled. Obviously, I'm watching price, right? We break above this high, look for a breakout. If we take out all-time highs, 4,800 around that area would be all-time highs. If we blow through that, things get really exciting. If Ethereum blows through 4,800, you got to wonder if Bitcoin makes a run. We're at all-time highs on Bitcoin at 70,000 plus. If we break those all-time highs once again, is Bitcoin destined for $100,000 spot price, right? Maybe. So what am I trading here? Trying to trade some Ethereum futures with some credit spreads. That's pretty much it. You know, defined risk. There's micro Ethereum futures. There's Ethereum futures. It's a pretty simple trade for me. Also, just having some Coinbase holdings as well. All right. So dollar, oil, gold, silver, Bitcoin, Ethereum. Let's go indexes right now. Let's go ETFs. SPY trading at 523. Let's go to this chart right here. This is a pretty good intraday chart that I follow pretty closely. So a couple things to take away from this. I want to mark that NVIDIA candle from last week. Two things happened yesterday that I was pretty interested in following. I think, so here's a safe trade for today. I could probably do this. It's going to cost me some money. It might cost, but I'm pretty sure I could do this trade. If it's worth it, let me see. SPY. If I did a 530 put today, oh my gosh, never mind. It's not worth it. Maybe, I mean, I'm not going to be in town on Monday, so that'd be a stupid trade. I was like, what if I went to Monday the 3rd and sell a 530? I mean, I'd get 12 cents credit. That's not good. So no, I don't want to do that. What I was thinking of, and I talked about this yesterday, I could have gotten about 85 cents yesterday had I taken this trade, but we were right at last week's low. So last week's low is right here. You can see that this red shaded zone, that means that the candle for the week is red right now. Probability is it stays red for the week. Okay. So we opened here. We're down here. I doubt we're coming all the way back up here for the day. All right. So we'll probably remain red for the week. The problem is I can't really get a good trade. I mean, if I were to throw the equivalent of the SPX all the way above that high, here's the SPX. You know, should I throw in a credit spread at 53.10 or, I mean, I could do something probably at like 5,300. I doubt we're moving all the way to 5,300 today, but let me see. If I get some credit on it today, I'll take a look. I mean, the IV rank is still very low. It's not 2 like it was last week, but let me go trade SPX for today, end of month. What was that strike price if I did like a 53.10 or a 5,300? Again, the credits are probably garbage. 5,300. Yeah, I mean, you pick up a whopping 10 cents for a $500. Would anybody take that trade? I'll make $10 today for a $490 risk today. Safe. I mean, the probability is high. You know, it's a 96% chance of profit. If you want to flirt with some POP a little bit, 94% chance, grab 15 cents. Could probably move this a little bit lower. You know, 25 cents in the day. I've got to throw it out there, risk 475. It's not ideal. But probability wise, we're still at 92%. Likely that's going to be the trade. So not bad for a single day. I could have an 89% chance of profit, grab $40 today. You know, those are high probability trades. For 52.85, where would that be? 52.85. I mean, that's doable. I mean, if we opened up here from yesterday's close, 50. I mean, that'd be a 50-point move. It's an attainable trade. I mean, last week we saw, an $8 sell-off on the SPY, an $80 to $90 move in the SPX. If we have a high volatility day, it does move that. So I'm looking at, is it capable? I mean, we can go $40 to $43 on average. We can certainly exceed that when the market's been pretty quiet. So for the week thus far, this candle is actually showing, I mean, that's a pretty textbook evening star on the SPX, if you ask me. Coming into next week's trading with non-farm payroll, coming into the following week's trading with CPI data and on the Fed. I mean, again, the Fed can try to talk the market down, and they might succeed, right? They might succeed with having this firm narrative, and maybe the market's like, here's the rip to the upside, pull back, rip, and we just deal with some volatility. I mean, who is equipped to trade if the market is not going up all the time? Who's equipped to trade when the market does this for a while? You know, traders are equipped to trade that. You know, everyone that has no idea what they're doing just buys calls and hope it all works out. You know, you get paid a lot of money. I'm not going to lie. It's nice to see a bull market, but There's a thing called bull market geniuses, and sometimes they disappear in 2022. They disappear in 2020 for a couple of months. They get busted up on certain trades when they're dead wrong, right? But if we go sideways, we got to figure out how to make some money. So I'm not sure what we're going to do, but to me, this is like a pretty classic evening star. I mentioned divergence a couple weeks ago, being mindful of that. We're overbought on the weekly chart with divergence. I could see a bit of a pullback coming. Now, there are a couple ways this plays out. To me, this is either, again, if this is it, if this is an evening star that goes no lower and we just go higher, okay, great. But I could also see this being a little bit more downside pressure, and then it's a real important spot of whether we take out the low or not. If we take out the low or we tap that low, to me, that is a broadening pattern opportunity where we end up making higher highs off of lower lows. Just like I would see on gold, we could see the stock market do that. Now, that would be incredibly volatile if we get that to happen. But I'm still in the camp of I would have the courage to be looking to buy these dips, right? Because I don't think the year is done. I don't think the market top is in. I think we might, struggle to justify blow off tops. But even with a lack of news this week, what came in pretty well? Earnings, for the most part, came in surprisingly better than I thought. I mean, when I was on the session with Frank, we're looking at Abercrombie and Fitch, and we were looking at some retailers like Dick's Sporting Goods. Was it Burlington? Burlington stores up. I mean, up $30 to $40 for the week. I mean, Chewy, my near and dear Chewy, it's up to $21.48 from lows around $14, $15. So there is some catch up trades that are happening here, and that's a good thing. So if we go to a heat map, let's see what the weekly performance looks like. Not intraday. Let me go back to the homepage here. So intraday, it's opening bell. This should be showing some colors here in a little bit, but I want to go to this. Let me go heat map. Let's go 1 week. So if we take last week's price to this week's price, we still see a lot of red. We go any further than that, go out to the past month, everything's still clinging to those greens, right? Led by the big ones, led by the NVIDIAs, led by the semiconductors, led by the Mag 7, the Fab 4, whatever you want to call them now. Costco was down about $5 today, and it's still hanging in there. We're at $8.15 if that's current price. Let's check the real price. Walmart blew off the top. Amazon's still clinging. I mean, $180. It's down about $4 or $5. But anyway, to me, it's better to be, in a bull market. It's easier to trade, most certainly, but it's going to come with some volatility, more than likely. So what am I looking at since I'm not here next week, right? What am I looking at? Well, I'm looking at, and this is how I position myself. I'm looking at potential ratio spreads down here on these major ETFs. So the SPY, the diamonds, the Qs, the IWM. If price falls to this area, I have a +1 put, which means I'm long a put, and I have a -2 put, which means I'm short 2 puts. So what that is that's actually a bear put debit spread that if price falls, I make money on the debit spread, and then I'm also getting an assignment at a price that I'm interested in owning the shares. So if I took any shares of the SPY or the Qs or the diamonds, I would own shares down here. And to me, if I'm owning this at a pretty significant discount, if we had price fall, let's say 9 or 10%, I'd own it at a 10% correction. I think that 10% correction is enough to justify getting back to maybe an 11 or 12% gain to the upside and get those highs revisited. That's my thought. Okay. So because we have a nice little classic evening star, I could see the Fed putting the pressure on over the next couple of weeks and pushing the markets down a little bit. Or if it just ignores the evening star and drifts higher, the Fed then talks it down for the market to buy the dip. And we're talking about blow off the top type moves. And, we're looking at levels like, hey, can the S&P hit 6,000 this year? I mean, I think every major investment bank out there has forecasted like 54 to 5,500 this year. They've all shifted their price targets. When the year started, everyone was expecting the S&P to be around 4,800. Okay. It's at 52, 55 already, and we haven't even hit the halfway point. So we're way beyond expectations. So either we go nowhere for the rest of the year because, there it is. We checked the box that the S&P had its big move, or this market is going to have a year to remember, and we go into a new, new administration, and we'll see what the heck happens in 2025. I don't have a lot of faith in 2025 as far as the bulls continuing this run. This little rip to the upside to what we're seeing now, if we have a 20+% year in the markets this year after this run, that would be like a 30 to 40% move. I would expect a correction coming in 2025. I think this reality of, higher for longer, or whatever the Fed cut cycle looks like, part of me was wondering about it this week. If the Treasury yields, and we haven't talked about this yet, but if the Treasury yields continue to push higher, this is a crucial part of how these markets are going to behave. If yields continue to inch higher, and it's not really the 2-year, it's not really the 3-month. The 3-month's been sitting at 5.3% for months. The 2-year has rallied off these lows from 4.14 to almost 5%. The 10-year is what we really need to pay attention to. The 10-year yield today has faded, or this week has faded. This is probably good for the markets, right? If the 10-year pressure continues to mount, a charge to the upside to that 5%, that's not going to bode well for stocks, okay? If this all of a sudden turns the corner and starts to break the structure to the downside, that's probably what helps fuel another rally in stocks. If we see yields going down, bonds going up, what's interesting is many of you that have been trading for a while understand that there's an inverse relationship between yields and bond prices. If yield prices go down, bond prices go up. Yield prices go up, bond prices go down. It's inversely related. But there's also been a strong positive correlation between bonds and equities. So instead of the 60-40, hey, if my stocks are down, my bonds are fine. If my bonds are down, my stocks are fine. It hasn't been the play. Bonds have been in a 3-year drawdown that was saved by October, November's rally last year. They barely missed a 3-year drawdown, which has never happened in the history of the bond market. Okay. And that was because of a positive, lift all ships type thing towards the end of the year that carried us into Q1. So I'm watching the 10-year closely because this will be a big factor of risk off. Okay. This is risk off trading, and this is risk on trading. Pretty simple instrument to watch, right? And it's not easy to read, and it's not always super technical, but a lot of smart people that I'm following out there are talking about the bond market having to steepen the yield curve before it normalizes, or get out of this inverted yield curve before the Fed can do anything. So we've been in one of the longest inverted yield curves ever, and people are starting to question the integrity of, that inverted yield curve means a recession. I still think it matters. If you don't know the history behind that inverted yield curve, sometimes it can take 16 to 24 months. We're not past that. We're on like 400 days. Okay, so we're just over 12 months into this inverted yield curve. It can take sometimes 16 to 24 months. So we might stretch this all the way into the end of this year until we get out of this inverted yield curve, and then we wonder like, we dodged a bullet. There was no recession on the inverted yield curve. I would say just wait, because it's probably going to show up again and be like, hey, remember that inverted yield curve that lasted for 400, 500, 600 days? Here's what happens. Recession, but probably not now. So anyway, watching the 10-year. Let's go to the Qs. So we have a nice little evening SAR on the SPY. The Qs with the weekly candle, again, looking pretty ominous. Pretty straightforward candlestick formation. That looks like a dark cloud on a weekly time frame. Now, this doesn't mean that it has to be the right candle, right? It doesn't mean that we have to have follow through. But just like I said over the last couple of weeks, with that NVIDIA sell-off, just watch this level, right? We had all direction correction, all direction pause. It's just a market cycle. If this market doesn't want to go anywhere, what's going to have to break it loose? All the news. What's all the news? Well, we have non-farm payroll, we have US CPI, we have the Fed. If the market, I'll make this really simple. If the market shrugs off everything and goes higher, I would not fight that trend. I would not fight the trend. The market can remain irrational longer than traders remain solvent. I'm not going to be a perma bear that gets stopped out all the time and just waste a bunch of money on trying to be short. So instead, I'll wait, right? If we get a breakout this way, it would make some sense that we could have a correction. That correction to me, is it as nasty as we saw back in April? Probably not. I would say a correction in here, we could form a higher low. So we go up here, we have a low, we go higher low, we go up again. Now this would be a bit more concerning, right? If this starts to look like a rising wedge, again, I've talked about this, two ways this plays out. Does this rising wedge actually break back down in a corrective fashion? Or the tricky part of a rising wedge is it looks like it's so overbought. It looks like it's going to sell off, but it goes like this. Boom. And it blows the top off, right? And there's a lot of money to be made in that type of bubble type move, but there's even a lot more money to be made when eventually this does correct, because it will eventually. And the unfortunate thing is it's not going to feel like a normal market. It's going to correct with some type of recession. It's going to correct with some type of terrible news. It's going to correct with something like, we're going to have a bust. We're going to have a crisis. And then the Fed's going to have to come in and fix it. Here's going to be a big reason to watch. And again, I'm probably talking, longer term and bigger picture stuff. But does everyone know? Type in this wire yes if you understand. Have you heard the phrase Fed put, the Fed backstop? Have you heard that phrase before in trading? We've essentially had it for 20 years, right? Every time we had a crisis, the Fed steps in. 2000, 2001, Fed steps in. 2008, Fed steps in. 2011, Fed steps in. 2016, Fed steps in. 2019, end of 2018, 2019, Fed steps in. 2020, Fed steps in. Okay, 2022 into 2023, Fed steps in. It's Fed backstop. This is why the saying is, don't fight the Fed. So what I'm getting at here is, let's say that the market starts to drop. Okay, let's say the market starts to drop, and the Fed all of a sudden says, "Hey, we're going to cut rates. We understand, blah blah blah, price stability, liquidity. We want to stabilize," and the market still sells off. That's where I'd be a little bit worried. If all of a sudden the instant V bottom isn't forming because the Fed all of a sudden steps up and says, "Hey, we got it," but the market doesn't respond favorably, that would be a big concern for me. Now, that might not ever happen, but if it does happen, that's something I want to watch, because that would sucker so many traders into getting long in a market that's a falling knife. And that's not something you want to catch. So just being mindful of, maybe there is a point that the Fed can't print enough money to stabilize. It can't add enough liquidity to stabilize. It can't backstop and all of a sudden, put in instant optimism to the market and essentially put in a backstop that the market rallies from. That is a legitimate concern. I think you're silly if you're trying to ignore that and say, like, well, if the Fed steps in, everything's going to be fine. At some point, maybe it won't be. So a lot of you say yes and no's in there, but yeah, the Fed backstop, the put. It's just the phrase where every time we've had a major crisis or something that looks like somewhat problematic. I mean, heck, even this little 5 to 6% correction, everyone's like, what's the Fed going to do? They're going to start cutting rates now. It's like, my gosh, man, like, you think about the last 24 years of trading. I mean, the 90s was pretty much the heyday, but they came off of like a tumultuous decade from the 80s with high inflation in the 70s, all sorts of nonsense and volatility in the 80s. The 90s, they finally got it right and had a nice little decade of growth until they blew it into a bubble, right? 2000, 2001, 2002, tech could do no wrong. The internet, the age of the internet could do no wrong. Dumbest valuations ever, and it ended up being a crazy bubble. Amazon was down 96%. The NASDAQ was down 96%. Some companies are, I mean, it's surprising that some company even exist after that. Or, even 2020 was bad. 2000 was ridiculous. 2008 was awful. I mean, we've seen like crises, but we've seen like milder and milder crises. And again, that's because of heavy amounts of manipulation. So anyway, I'm talking a lot, but it's just, we've got to be aware of this stuff. If you think that this market goes one direction or you think it's one dimensional, you are sorely mistaken. These markets are so dynamic that is why it is nice to have multiple trading strategies. That is why I trade Forex and I trade futures and I trade stocks and I trade options, because something always allows me to get paid, hopefully, right? I can be market neutral. I can have a bias. I can, be a little bit more tilted one way. I can favor a certain trade for risk reward. I could go after little wins. I can have income for, weeks to months. I can have long-term gains. It's all over the place. But when it all adds up, it's just one big portfolio mix that hopefully I end up making some money. All right. All right. So that's the Qs. I see a dark cloud cover. We've got some news over the next couple of weeks. I'll go back to this. And again, I just want to wrap these points up before I go into the next one and just make this really simple. If we see price breaking out, let me use a straight line. Okay. So this high, this low. If price breaks this low, we are inching into some more correction territory to the downside. Okay. Couple other things too. If we look at the weekly and monthly chart, I did take a look at this on a, let me go. I have a dashboard here that helps me with some weekly and monthly data. Let me go into, where's my green and red streaks? There we go. So on weeks, the market, this is the SPY, by the way. I can go Qs as well, but the SPY on average has about 3 to 3. It's the average is 3.2. Okay. But it has an average of about 3 green weeks in a row before it pauses. So we had 1, 2, 3, 4, 5 weeks in a row, and now we're going red. Okay. How many months in a row? Average green months are 4. So if I go to the monthly chart for the Qs of the SPY, have we had, how many months in a row we had a bullish push? We had right out of the gates. This is November, December, January, February, March. March was barely a bullish month, but it was enough so that we had 1, 2, 3, 4, 5, and the average is 4. Okay, so for the SPY, average is 4, and we had 1, 2, 3, 4, 5. It wasn't a surprise that, number one, I was getting bearish on that 4th month, and I was wrong for most of March. I expected a correction coming in February, March. It didn't really happen. But April, we had a nice correction, and the bearish trades that I had played out really nicely. But here we are, kind of starting the cycle over again. So as I go into the week for the SPY, depending on where we end up closing today, this is, like I said, a textbook evening start. If there's follow through to that, we could have some more downside. Where to? Let's go to the daily chart. There's still some gaps to fill, right? Who remembers this a couple weeks ago? NVIDIA gap just got filled. Here's Apple. If the market pulls back, where's a good spot? Well, if we sell off a little bit more, we can fill some of these gaps. We can find some liquidity. We can find some demand down here. This Apple gap area around 508 to 510, not a bad spot, right? High or low, if that is enough to lift the market back up, we just see a channel forming at the top. That's fine. If it gets a little bit nastier, then we go to the downside. I'm looking for a broadening pattern. That's a bear trap. It still goes to the upside, in my opinion. Okay. Let's see. Maine is making a good point there. You're saying the Fed put might come in long positions, gold, Dow. The Fed put it's out there in the distance. I'm not saying this. I don't think this is happening anytime soon. I think this is probably a 1 or 2 year thing. But I would say that a good position for me is I am long gold. I am long Bitcoin. I'm long silver. I'm long non-US, right? So, I mean, there's other factors that I can still benefit, but you have to remember, if China is a crazy bull market, is it enough to lift the entire global economy? Yeah. It's the number 2 power in the world, right? It would help if the US and China collectively are both in bull markets, right? It helps that, Europe's in a bull market right now. The UK is in a bull market right now. Japan's in a bull market right now. US is in a bull market right now. And then China's starting to wake up for the first time in 2 months, or I'm sorry, 2 years. That's a good broad market rally. But if we have all China, all non-US, and the US is struggling, or vice versa, it's like you see this kind of fragmented bull market where it's like the US can do no wrong, and then everything else is underperforming. So it's, I mean, do we get everything aligned? Maybe, but probably not with all the geopolitical tensions that seem to be out there, where it's like, look, if we can all get along, global economy can really crank. But if we're going to be, fighting tooth and nail, and who knows if it's going to be another war, more conflict, China, Taiwan, all these other threats that are out there, all hypothetical, maybe they happen, maybe they don't. It's tough to get a full consensus that the entire world can get wealthier through the markets. So that's why I said I like diversified trades. Long on gold, long silver, long Bitcoin, long Ethereum. Those are totally fine. Long non-US, that's a hedge to me, right? So anyway, and by the way, there's ways to get bearish on the market without actually having to take a bearish trade. Just so you know, right? You can trade inverse ETFs. There's other ways to buy utilities. I mean, utilities, the financial sector, and consumer staples. Those three are typically defensives. Those are typically, steady or stable or outperforming when the market is down. Like when, tech corrects in a big way, utilities does okay. Finance does okay. Staples do okay. Energy does pretty well. But anyway, there's ways to still maintain like this bullish trade, but also, you're basically playing defense against a potential correction. So, all right, let's go to the Dow. I saw US 30 earlier. This is similar to the Dow. So US 30. So the Dow has been, this is kind of what I see the rest of the market doing. It's almost like the Dow has been leading this correction. I think that there's still some more catch up to be had here. But if we take out this high, which we did, if we test this low, now I could see this work in a couple of different ways. This could be a broadening pattern, right? Where I connect these lows and maybe the Dow is headed for a slightly more correction. If the SPY sells off, if the Q sell off, I'm sorry, but the Dow's probably going to get a little bit softer too. Okay. So my US 30, if it gets a little bit softer, watch these lows before we see a bit of a bottom. That is a pretty deep correction compared to others, right? So this would be a 7 to 8% correction versus, I mean, we'd have to have I'm trying to think, probably the same thing, like 7-8% correction on the SPY, and maybe like a 9 or 10% correction on the NASDAQ. But I mentioned this before on the DIA, which is my representation ETF trade of the US 30 or the Dow. I have ratio spreads. We're trading at 381. I have a ratio spread right now at 384 by 379, which means I would take assignment at 379 if we get there and expire. I think this is let me check the expiration here. So my DIA trade is ratio spread is out to July. So I have it's right here. So a July 19 ratio spread, the 384 by 379. I've got my 2 puts at 379, my 1 long put at 384. If I take assignment here, I believe I collected about $1. Let's see here. Collected $1 there. So I collected 94 cents plus a $5 credit. If we're below 379, I own the shares around $373. So if I own shares at 373, that's right here, right around this yellow box, right around this previous all-time high test. I mean, I would take that. I think I could repair that pretty easily and flip it for a couple of bucks. I could also sit on it, own it, and see if price wants to go back to highs. If it does, guess what that means? That's a nice little rally, right? I could turn 100 shares into a $30 move or $30 a share profit. I wouldn't mind that either. Okay. Someone asked me how to join options classes. Let me do this. Let me share my Discord at the end of the session today. That's an easy way to jump in. So live sessions like this, I do my own live sessions. I jump in with Nick and the team and A1 Trading on the regular through the week. I have trading rooms as well. I have a couple of, I have a Forex trading room, a stocks and options trading room. I have some trial prices out there for like $27 a month. So you can try it out, be with me for a full month, have the live sessions. And that's a good way to start, get your feet wet. Cool. So I'll share my Discord. That's a good way to jump in and you can explore. I've got a whole education thread that has all my courses and trading rooms and stuff like that. Cool. All right. So what do I see on the Dow? Well, this has been a big disconnect between the SPY, the Qs, and the Dow. Why is it that the Dow is underperformed? Well, does anybody follow this? Does anybody follow the Dow 30? Right? Do you follow the stocks that are in this? Like United Healthcare is getting smoked right now. McDonald's is down. Like there's major players in this holdings that are just performing like crap. That is why it's down, right? S&P, broader market, 500 stocks that are pretty much being carried by the biggest, healthiest tech stocks in the world right now, the Fab 4, the Mag 7, the what have you. And then, of course, you've got the Qs, which is all tech and led by NVIDIA. That's pretty much where we're at. So we have real companies like blue chip companies that are sucking right now, We have the mega cap, multi-trillion dollar large cap tech that's kind of seen as value now. And then you have NVIDIA. That's pretty much your entire market. The Qs, look at NVIDIA. The SPY, it's still the Mag 7. The Dow, it sucks right now. Even though they're high quality companies that have a lot of cash, that have good dividends, it's obviously underperforming. There's been a really interesting disconnect. Like, this is a lot more volatility on the Dow, which is traditionally less volatility. So again, I still like this overall, but where am I looking to own? I'm looking to own it down here, or maybe not own it. If you can't afford to own it, that's fine. Just credit spreads down here, right? If it comes down low enough, I mean, there's some good credit spreads to be had to see this thing just generate some income. So that's what I'm doing on the Dow. We did the Qs, we did the Dow, and we did the SPY. We did the SPX. Okay, similar, right? We're starting to crack below this, so I can see a little bit more downside. Can we please test some lows today? Can we please hit like 520 or 519 today, please? I'll be honest. I don't want to see price, and it obviously price does whatever it wants. But I would like to see that my visual roadmap here with these higher gamma levels, I'd like to see them tested today. Why? Because I want to make some money. If they stay where they are and they just stay here for the day and nothing happens, then, we've had basically 0 good trading days this week, right? This was Tuesday. This was Tuesday. This was Wednesday. This was Thursday. All it was the market going lower, gapping. Very little price action intraday, which is incredibly difficult to trade. But if we can have a little direction today, the high is around 524.80. If we get a $4 move, I'd be pretty happy with that. $4 to $5. Let's see if we find this 519 to 520. So again, that's my selfish indulgence. I want to see if we hit a price level that I can actually make some profit. So let me see if I've got any money on this put right now. I'm probably still down a little bit. So if I go May 31st for this account, position SPY, I'm down close. I mean, I'm down a whopping 3 cents. So, I mean, I'm not down a lot. I want to see if this will cooperate. Look, if it goes down to 522 or 521, if I can turn this into, $2, I'll take some profit. Come on. Let's go. So anyway, that's what I'll be watching till closing bell today. Like I said, I'm not going to be with you next week at all. I'll be out of town myself. We're still trying to figure out where we're going to go. I'm also heading out international. That's the plan. We're trying to get to Germany, trying to get to Iceland or Switzerland or somewhere. We just haven't finalized the flights yet. So we'll go somewhere. But I'll be checking in, just spot checking, probably do some Telegram updates, Discord updates, but no live sessions from next week. But I'm excited to have the week off, go see someplace beautiful, get outside for a second instead of sitting on my butt all day, and then coming back when it gets really exciting, June 10th through the 14th, where we have CPI data and FOMC and the Bank of Japan, all on Wednesday to Thursday. We have CPI and FOMC the same day, which is different. And then we have BOJ the night after. So it's going to be a pretty wild week. Next week, we have non-farm payroll on Friday. We have a lot of news to digest. Central banks may be making some policy changes. And then same thing here. So we have like 5 rate decisions in the next 2 weeks. So the Forex market's going to get pretty exciting. I'd be ready for that. Okay. All right. At this time, let's see here. At this time, let's do this. I pretty much covered my top, top down, right? So my dollar, gold, silver, Bitcoin, Ethereum, futures market. I haven't really done many currencies, but whatever you want. So you want to post some charts, post some questions. I'll go for a little bit longer. I know usually I jump on the session at 10 and I struggle to cap it at 11, but I think I'm good for maybe the next 15, 20 minutes or so. And then I'll wrap it up and close it out for the day. So US 30, we just talked about it. What do you want? US 30, it's the same as the Dow. It's the same as the DIA. This is what I see. Either we stop going down, or if the SPY and the Qs add to this fuel to the downside, we're probably coming down a little bit lower. I think we can tag this low. This might be a sideways range on the US 30. right? This is either sideways or this is a slight broadening pattern where the bears get trapped down here, right? It looks like, oh my gosh, it's going to sell off a ton, but then it just starts to bottom out and starts to rally, and we go back up, and it's just volatile, right? I mean, and I just want to ask everybody, how many of you have traded patterns in the market? How many of you have traded ranges in the market? How many of you have traded structure that's not just a constant trend? You know, I mean, the market doesn't do this all the time. The market doesn't do this all the time. Sometimes the market doesn't do anything. So we might be in one of those phases where we've had a heck of a run. We've had a lot of trending here. If the market's trying to justify how it can trend again, maybe we have a quiet summer. Maybe. Maybe we don't. I don't know. You know, I don't have a crystal ball, neither do you. But I will be prepared to strategize accordingly. So, like I said, I am doing positioning down here that I think there's enough support to justify a buy low opportunity. If we get back to the highs, that's a bonus. All I really want is if I get $1 credit down here and it goes up, I get $1 credit, I keep $1 credit. That's all I'm doing. You know, if I take any assignment and I can turn it into $20, $30, $40 of profit, that's the bigger bonus. But if I just make $1, that's it, because I'll do that 1,000 times. All right. So it looks like we have some currencies popping in here. Let's go. Let's just go alphabetical. How about that? I'll give you a little taste of my flex trading room. We go through everything alphabetically. I've said this before on the show. I say this all the time, my trading rooms, my live sessions. You know, I'm right now exposed on 11 currency pairs. Okay. I'll summarize this. I think I did this last week, but I'll do it again. I'll give you every currency pair that I'm in. I'm bullish on the Aussie CAD, and I'm currently long with live positions. I'm bullish on the Aussie Swiss. I'm currently long. The Aussie New Zealand, I am short, so I'm bearish. Actually, how about long and short? I'll just tell you my position. So I'm long. I'm long on the Aussie CAD. I'm long on the Aussie Swiss. I hear some scuffling going about. What's up, Frank?
Hey, what's up?
Hey, man. I am short on the Aussie New Zealand. No trade in Aussie dollar. CAD Swiss, I'm long. Let's see. CAD yen, no trade. Swiss yen, no trade. Euro Aussie, no trade. Euro CAD, no trade. Euro pound. I just got poked out to the downside. It's a chop suey pair. Trade my robots on Euro pound. I'll look at it though. Euro pound, no trade. Euro yen, no trade. Euro New Zealand, no trade. Euro dollar, no trade. Pound Aussie, I'm long. Actually, I closed profit yesterday for like 30, 40 pips. Pound CAD, I was long. I closed out for some profit yesterday. Pound New Zealand, no trade. Pound dollar, I'm short currently. New Zealand CAD, I'm long. Oops, I forgot. I skipped pound Swiss. So Frank, just give me a second here, and then let's do. You and I need to have a little celebratory talk about some earnings this week.
Yeah, we do. There was some crazy moves this morning too. On Costco ended up doing something. It's down like 3%, but the prices are just going crazy.
Yeah.
That my P&L is all over the place. So Alta win. It opened above where I needed it to be.
Okay.
And then it immediately came all the way back, and I could not get filled at any price. So I am now sitting in a loss on Alta, but I still have till next Friday.
Oh
But
boy. This is
basically it opened pretty well above where I needed it to be.
Dude, way above.
As soon as the market opened, I was trying to close it, and it just kept falling and falling, and now it's back to where it was.
That's insane. Well, I get so I'm very lucky on Alta because I thought, wow, for a $40 gap higher, there's no way it's going to come back to 385. Well, let me look at it right now. I mean, clearly the price is selling off a little bit. Before I switch over to talk earnings with Frank. So these are all my positions, just so you know. I'm long Aussie CAD, long Aussie Swiss, short Aussie New Zealand, CAD Swiss long, pound Swiss long, pound dollar short, New Zealand CAD long, New Zealand Swiss long, dollar CAD long, dollar Swiss long. That's my entire Forex portfolio right now in a nutshell. A lot of these are built up in multiple positions. I'm break even or better on Aussie New Zealand, and I am holding the rest. I've got a stop loss in on dollar CAD. The rest I'm kind of position trading. So anyway, that's that. I saw some requests. Somebody asked about Euro pound. Let me get that one out of the way. Euro pounds. naturally it's going to come up. It's going to spike me out the low. And then, I mean, whatever. This thing is just sitting at support. I just hate this currency pair because it was like 30 pips a day. But I like the low if you want to buy it. But my concern is that we have the ECB next week. And if they cut rates, this should fall. So I don't like the trade right now. It's a slow mover either way. I'll just let my robot keep trading. But if the euro finally, flinches and the euro pound gets stronger the pound gets stronger than the euro, then there's certainly some room to the downside where we could actually have a trend for the first time in a while. This pair has been trendless pretty much since Brexit. That's a long time. So could we go from 85 down to 83? Yes, but we want to see a nice clean break of that support. Otherwise, it holds firm and we go all the way back up. We just stay in this range from like 85 to 87. So it's a very choppy currency pair. Euro dollar. And look, anything on the dollar, watch the DXY. The dollar is absolute garbage right now. And I think you got to wait for the next couple of weeks to get a better sense of direction. I don't have a sense of direction on the dollar. Euro dollar is heavily weighted in that. So I have no trade in the euro dollar right now. All right, Frank, let's take a look at Alta because I have credit spreads in. And let me see what they're trading for. I might do a safety first trade and a couple of things going on right now. Let me see what my SPY is trading for. We're getting a sell off, like I said. Now my $1.20 debit's up about $50. I think I'm just going to play it. Come on, direction. Come on, gammas. Let's go to 520. Let's go to 521. I'm going to try to grab this thing for $2, man. Try to get $2 here. Don't be greedy. Just grab my $1.90. $1.90 survey says.
Where was your
filled it at $1.90? Okay, grab.
Where was your credit spreads at?
I had a 385 by 382.50. So that's what I'm gonna look at right now. So I'm gonna grab. So let me do a quick thing. I'm gonna put in. So I did the 523 put for today's expiration. They're all up in profit. I'm gonna go ahead and take. Here's the SPY. This one in the money. So let me close this one out. $1.80. Actually, you know what? I'm just going to put a stop loss in and see if I get lucky. So let me go. This is going to be a stop market at $1.30. And that's in. So I'll let it marinate. If it pushes higher, great. If not, I can get filled with like a 10-cent win. It's a break-even trade. I'll market fill at $1.30. Let me get these in really quickly, and then I'm going to take a look at the Alta credit spreads. So positions, SPY, close. I'm just going to put in that stop market stop loss, $1.30.
So instead of an iron condor, you took a credit and debit spread on Alta.
I just did a credit spread. That's all I did. I just did a bull put spread at the money, and I collected $1.40 out of a $2.50 risk. So my risk was $1.10. My reward is $1.40 per contract. That's all I did. So when it was up to 420, I was like, sweet, I don't have to do anything. But it's pulled all the way back to 390. So I want to see what it's trading for right now.
So a bull put spread is bullish?
Bull put spread is bullish. So I sell the put at 385. I buy the put at 382.50. That's a credit spread.
Okay.
Yeah. That's all I did. All right. I'm going to put a stop loss in here. So stop market at $1.30. I'm just going to get all these in. So what I'm doing right here is just putting in a break even or better on my credit or my long put. And what I'm looking for is, like I talked about before, is I'm looking to see if this will actually come down and find my visual gamma levels, my 520, 519. If that's the case, my $15, $20 debit's probably going to trade for $2.50 to $3 profit. And I'm going to go ahead and take that. So that's what I'm watching right now, but I need to get everyone's stop loss in to make sure that at least a break even trade. So let me go here, 523 flows. This will be a stop market at $1.30. Putting these all in. I've got 3 more accounts to throw in, and then we'll talk Alta. SPY, close, stop market, $1.30. So I'm already up 80 cents right now, which is pretty solid. We pushed down and break the low of the day. That's even better. And I'll adjust this. So what I might end up doing is putting in a credit or just take the profit at, if I can get, extra. Let's see if it just hits my level. I'm break even. Let's give it a chance. Let's give it a chance. All right. So close here. Stop market 1.30. So I'm giving myself about a 10-cent buffer. to get, stopped out with a small profit, but not losing on the trade. And then here, same thing, close, $1.30, stop market, done. All right, so let me just, no, fudge, I hit the wrong button. Well, that one's out for 87 to 16. That's up 70 cents, 71 cents. I didn't mean to do that one for a credit, but whatever. So that one's out. This one's in with the stop loss at $1.30. Stop loss into $1.30. Stop loss into $1.30. Rinse and repeat. Repeat and repeat. And dollar. Okay, so we're good there. Okay, stop losses are all in. Now let's take a look at Alta. So what did you have running on Alta, Frank?
Let me check.
Okay, so all I had was my 385 by 382.50. Right now, this expiration, so today, the 385 by 382.50, I might just close everything if it's not awful. So, I mean, I can show. So I took the trade for 250. I can close out everything. Let me see here. Let me go Alta 1, 2, 3, 4. Close. So I could close out for about 80 cents net profit today. If I go to this other account that just had one credit spread, I can do the $1.30 is what I collected, and it's trading for about 80 cents right now. 80 to 90 cents. Now, here's what I have the luxury of doing. Right now, if I don't do anything, right? So there's a good and a bad. The good would be, we were at 422 and we're coming all the way back down to now we're at 390. Now, if we stay above 385, I can collect my full $1.30 and there's no assignment, there's no anything, there's no risk. I just collect the full $1.30 on the trade. But if it comes in to that 385 level or that 382.50 level, then all of a sudden, I mean, I guess my break even is technically 383.70. So if price is, as long as price is, there's two ways here. If price is greater than 385, I don't want to, this is going to take forever. If price is greater than 385, then I keep full credit. If price is greater than 383.70, I'm break even to close by end of day. That's all I have to do. So for me on Alta, I can just watch it. So I think at this point, all I'm going to do, Frank, is I'm going to be here till closing bell anyway. So if I go to Alta and we've come all the way back down here, that's a really aggressive day. That's crazy, man. And I'm sorry to get filled, dude. That's a tough break if you're not getting filled where you're trying to get out, especially right at opening bell. That's frustrating.
So I have a 360 by 385. I guess that's on the put side of the Iron Condor, and then a 387.5 by 412.5.
Say that again.
So basically, these lines right here are the break-even zones.
Yep.
On my chart. So if they go above or below this, that's like the break-even point. If they go a little further to 360 on the downside and 412.15 on the upside, that's max profit. So anything above and below that's going to be good.
Okay. But what's your expiration for Alta? Is it today?
No, it's tomorrow. Next
Monday.
week. Next Friday.
Okay. Okay. I mean, you got some time then. So at this point, because price is right back in the middle, close to the middle, you might as well give it the time that it needs, I think. So for me, so did I get these numbers right, Frank, on my screen? 385 by 360 and then a 385 by 412. Is that right?
Yes.
Okay. So
387.5 by 412.
Got it. Okay. So 385 by 360 and 38750 by 412. So you went up symmetrical $25. Makes sense. Okay, cool. So with the expiration June 7th, next Friday.
Yes.
Okay. So a 6/7 expiration. All right. So because price is trading at 390, the only value you have right now is you have about $2.50 of real value on your call side. That's it. So unfortunately, like you showed the chart there, you're sitting right in the middle, and you're better off that price has to do something next week, good or bad. I mean, at this rate, since we had that earnings pop and it's fading, if Alta fades it lower and takes out those lows, then that probably helps your cause on the put side. But I mean, that is, man, that's like I said, it's a tough break. That at 422 opening bell today, you couldn't get anything to fill at a even a bid price to get your profit.
It was weird. Like nothing was filling either. I had Dollar General, Burlington, some I can't remember the other, but they were all pretty high in profit, and then I was trying to get them filled, and
Yeah.
it just Burlington didn't fill for 2 days, so I just sold it at a much lower price than what it was at. So I still
Okay.
collected it, but it was like only half of the profit, which is not really what I wanted at all.
Right.
But I'm just trying to collect money when I can. But at the same time, Alta's kind of been, just because of its move today, it's been very heavy on my account because it just did not want to fill.
Right.
But I don't know. I guess I'll just let it run. The same thing with Costco, except that was a much cheaper trade because I was doing what do you call it? Those weird spreads, those puts above price and calls below price.
Okay. So were you doing credit spreads?
Yes.
Okay. Let me see here. 8051 SPY. So I'm monitoring the SPY position since we just tapped the lows. I'm going to go ahead and I've got like $1 credit on these. So let me see if I can just close this. Hopefully I can get 220 for this. I'll take 215 if I can get it. I'm just going to, yep, there we go. Got filled at 220. Sweet. So here, SPY, close, 225. All right, I just got to do some broker work here. Moving that stop loss up to 225. Rejected. Now I can close it. So SPY. I mean, now I'm getting 229. Come on, man. Filled the 229. Perfect. All right, just let me make a couple adjustments to these stop losses. So here, $1.30 replace, move this up to 220. It got rejected, so I'll just replace the order. Close. 2.15. Don't be turds. Filled to 215. All right, I think I have one more to fill here, Frank. Replace order, $1.30, move it up to 215.
Are these just SPY puts?
Yeah, I did the 523 put, build at 212. All right. So the summary on those SPY trades, I'll walk you through that. So yesterday, basically this is what I saw yesterday. So let me get rid of this, and then I want to spend some time on your options trade. So also, by the way, like, I hope this isn't a distraction. I'm managing live trades on the air here. It's like, this is what happens when you're actually trading. And it's short term. So it's like, it's very price sensitive. I mean, I had those fills there. 220 and change was my best fill. 212, 215 was my worst fill. So there's obviously a discrepancy, but that's just because intraday price action, it's a little bit sensitive. So what I did yesterday was I saw all of these levels down here were lit up for yesterday's price. And so we had a gap lower, and I was looking to see, possibly we hit the 521 to 520 level. And rather than saying I've got to take the trade for today, and that would have been a 0 DTE, I went ahead and I bought it out to tomorrow, which is now today. So this was I took the trade yesterday. I did a long 523, if I can type it, 523 put. Okay. And so this was a 1 day to expiration. So it wasn't a 0 DT. It wasn't same day. I bought this out to Friday. So that 523 put right now, real value from 523 to 521 is $1.75, right? I mean, this is a quick lesson on intrinsic versus extrinsic value. So intrinsic value is the cost of my strike. So the 523 to current price, it's right now worth about $1.80. So real value, I'll put just kind of RV here, equals $1.80. Right? Now the extrinsic value would be the $1.80 plus time. Now I don't know, some people try to get fancy with how to calculate time. I don't. I just know that right now the market is giving me the rest of the day. And it's only 10:30 a.m. Eastern time. We have till closing bell today. So that time is still valuable enough to give me about 50 cents or so, like 40 to 50 cents of actual additional credit. So I'm getting about 40 cents of additional time premium in the trade, which is good. And what I paid for the trade, I paid $1.15 for the debit. Right? So I paid $1.15. I'm getting the real value plus the time, which means I'm closing out for about $2.20. So my net profit is about $1.05. And if I had $1.05 net profit out of $1.15 position, that's a pretty good chunk. I mean, it's almost 100% on a little tiny, little contract trade. Now, the reality is if I did nothing and I just watched this go, I might be better off just keeping the stop loss at break even at $1.30 and watch this thing actually go to the downside. And maybe this is trading for $3, $4, $5 later today. And I obviously cut my profits off early. But, I'm up 100% roughly. I'm going to take the profit and move on. But I feel like I'm a teacher doing a math problem on the chalkboard. And everyone's just like, what is this? What is this guy talking about? He's crazy. All right, dude, I'm done. That's good for me. I'm out of all these trades. So now let's focus on Alta. I'll put this back. So I will set a chart alarm on Alta. We're at 380. Oh, fudge, dude. I might just want to close this trade out. Now that let's talk about this. I think I'm just going to close it out. And I don't really want to have any, I don't want an assignment on Alta. It was just going to be a little simple earnings play. But, man, there's a lot of wild price action going on. So we're at 386. Yeah, I collected 252 on this one. Let me see what I can trade it and close it out for. Ugh. I'm just gonna take it, dude. I'm gonna be out of this trade if I can.
I would too.
Yeah, I'm gonna get out of this one at 230. I'm just gonna break even or better is totally fine. 230 is not filling. As long as I'm getting. The spread is so wide here. Come on, bro. You can't give me a 235 fill. All right, I'll try to make just a couple cents on it. All right, I got filled at 240, which means I made 12 cents. Hooray for me. But it's a break-even trade, and now I'm just going to get everyone else out as well. So this is, I collected $1.30, and I'm seeing the mid here at about $1. I'm going to go $1.10 and just try to grab 20 cents. It's not filling. You got to be kidding me, man. These spreads are ridiculous.
Costco too is kind of crazy. It had a really good earnings report. Like everything was good. They beat all key metrics, and then price just fell 3%, which is good for me. Like I needed to go up or down pretty hard, but it's just weird to see that. And Alta, I think, had really good earnings too.
Did they?
So this is kind of strange to see the market slowly kind of decaying too. If you've seen the past couple of days, since Tuesday of this week, it's just been a steady decline, and there hasn't been much talk about it. That this whatever this is just looks like a pullback, but what we've seen time and time again is within 1 or 2 days, if the market comes down, this invisible force comes back and pulls everything back up.
Yeah.
Now it's been 4 days of red. We're underneath our Thursday and Friday lows of last week, and we're still continuing to chug down, which is, this kind of looks like the start of something, but it's hard to tell. I think if we don't see any buyers step in and make this look like a bullish setup, I don't know. We're now, what are we? We tested the all-time highs again. We bounced off those last week, and now we're back below it. I don't know. Maybe the next target for the S&P is like 5130. Break below that is 40 or around 5K, and then 49.29. I don't know. I'm starting to see some weakness, even though we saw PCE come in this morning a little cooler than expected, which is probably you'd want to see that, I guess, for the Fed. Unless
you do. Look, I'm not gonna pretend to dig into the granular details of what's going on outside of, we said it would be weak. I mean, technically speaking, on a weekly time frame, we've had several weeks in a row to get back to these all-time highs that I really don't think were justified, because it was led by two big earnings reports. Apple lifted the market, which is number 1 in market cap. Nvidia lifted the market, which is number 3 in market cap. That's why we justified going to all-time highs, because we had massive gaps, right? SPY and Nvidia all by themselves, and yes, there were other earnings out there in the peripheral, but those two all by themselves lifted the market up to these all-time highs. And when I saw the weekly time frame that showed divergence, I mean, we can go to a weekly chart right here and go to these indexes, and you'll see that this indicator right here that just prints at the top doesn't happen very often, man. And when it does happen, I tend to pay attention to it, because last time we showed overbought conditions with divergence, we had a massive correction. Last time we see overbought conditions with, so it's the same situation where it's like, I just see technically we can't justify these highs based on momentum agreeing with it. So what I think this needs to be is a bit of probably a bit of a fake, where we're going to see if the bulls are going to step in. I mean, I think that's really the important takeaway is, if the bulls step in, where is it? Because, Nick and I talked about this pretty much all year. This rip to the upside, we saw like 1 to 2% dips at best. And then all of a sudden we saw 5 to 6 to 7 to 8% dip right there. And then we somehow eclipsed that to get back to the highs. Now, I do have an interesting stat. Anytime we've seen a 5% drawdown, this is an interesting stat for the history of the market. So if we have a 5% drawdown, okay, then we regain or reclaim the highs, which would be about with a 7+% rally. The market has, and I hate using this word because it's definitive, never been followed by a 10% drawdown. All right. Now, I say that because obviously anything can happen, and maybe this can be the first time it happens. But probability wise, we're likely not coming down into some massive corrective territory. So this is why I want to target, like, if we have some trickery here, this market with a broadening pattern can make things very dicey, because this high to low all the way down there is going to be about a 7.5 to 8% correction. Now, that still doesn't give you a 10% correction, but that's going to be a scary fall if we drop all the way back down to those April lows. And then, like, what's the narrative? April was like everything piled onto the Fed's going to be higher for longer. The Fed's not going to cut. The Fed's not going to do anything. It's going to be terrible. We're going to face a recession. Yields are up. All these things were happening. And what happened after that? Market didn't care. Now the market cares again, I guess. So I think that this is a bit of profit taking. This is your typical sell and may go away. So if we see some, we're closing to all-time highs, right? So it would make some sense for people to book some profits, go into the summer trading. Maybe things slow down a little bit volatility-wise. Maybe they do. So I could see that being a catalyst to why we're dumping a little bit. But it is giving a little concern technically. But guess what? We survived the next couple of weeks with, okay, so we have PCE data that shows softer, which is good. If we have CPI data and the Fed, whatever they're going to say on the 12th, we could be talking about this again at all-time highs. So as you and I had mentioned, we talked about this, online, offline. But I mean, look, man, if we come down here, I'm a buyer. I think it's trickier to be like, where's the bottom? Well, if the bottom's going to be here, I'm probably not catching that bottom. If the bottom's down here, I'm more likely to have the courage to catch that bottom or try to. Does that make sense?
Yeah, I got you.
So,
I
so
think
that's where I'm at. I mean, I just see this as profit taking for, the end of the month, and we're going into summer trading. And look,
I think you jinxed yourself though.
I think I
When
what?
you
Jinx
jinxed
myself?
yourself by saying it has never made that 10%
Well, that's
correction.
why my disclaimer was I can't say something. I personally would never say something definitive like that because I'm a trader. I know that I can't have a guarantee. That's insane. I'd be an idiot if I'm like, you can't promise anything in these markets. But
But now
statistically,
it has to happen now that you've said it.
sure.
But
Because I said
think
it here on air with everybody watching, now it's going to happen.
I
But
think
guess
it's
what? I'm positioned for it. That's what's funny is like if it happens, I'm positioned for it because I'm actually positioned to buy down here, as opposed to, oh fudge, what do I do now? It's like nothing. I just wait. If price comes to me, this is where I want it. I'd be happy about that. But I could see. I mean, there's a couple price styles that would make me nervous. If I see this happen, higher low, higher high, higher low, higher high, higher low, higher high, that would make me a bit nervous because that looks like it has the writing of a rising wedge. I do think that in the stock market, the rising wedge tends to be a fake trade and it tends to blow the top off, then have the correction. I could see that being the style of like through the summer, through the election, through the end of the year. It will be very frustrating to all of a sudden see direction take a massive stall. If we see direction go sideways, traders are going to be losing, right? Like for everyone that's like long and bullish and just buying call options are going to get their butt kicked because that time decay is going to just suck all the value out of those options because there's no direction anymore, right? So selling options will be much better strategy, but we're not there yet. So here's what I'm thinking. I'm out of town next week, but when I come back on the 10th, and part of me is interested in kind of doing this now if it's priced accordingly. So we're sitting here with a bit of an evening star on the SPY. Let's price something out together. I know that I'm looking out a couple of weeks, but if I went to, let's say, I want to see what the expected move is on the SPY. So our VIX is trading at a 61 IV rank. Our SPY is trading around 17. We're up about 5 points in the IV rank today. By the way, let me see. You turd. Now it's up 250. Oh well. I sacrificed about 20 to 30 cents, about 30 to 40 cents on that 523 put. Whatever. Okay. So SPY. Let's go out to next week Friday. I'm out of town. The week after that is going to be the 14th. So if I go out to June 14th and I look at an expected move right now, we're looking at about a $10 move. Now, I think that the market is very capable of moving more than that, right? This is saying that if I take a position right now at the money, this is anticipating about a $10 to $10.40 move one way or the other. So that puts the expected move down to 510 or the expected move up to 530. Now, here's what I'm interested in looking at. If I did a 521 and a 520, and I went, let's say, $15 wide, 521 to 536, and a 520 to a 505. Okay. I could pay $869 or $870 for an expected $10 move. Now, the reality is we can move a lot further than that, right? Now, why would I not take this trade right now? Because I'm paying too much for time. So let me drive this point home. I'd have to buy this right now and say I'm in now 2 weeks away to have this market move at least $10 for me one way or the other. So let's see what $10 looks like. $10 to the downside. So we go from 520 down to 510. Does that do any massive structure damage? Not really. If we go to 510, this gets me into basically the Apple. Yeah, this is 508, man. If we get into the Apple gap right there, that's 508. That puts me at like $12 of real value. I mean, I can make some money on that trade if we fill the Apple gap. The other side of that would be if we get back to the highs at 533, that's $13. So I guess the question is for you or me, if I'm taking this trade, if I put in a trade right now and we break the highs or we fill this Apple gap, that's the directional play. If we go to that level, you're sitting on $13 in value on the trade. If you're going to this level, you're sitting on $12 of value in the trade. If I pay $8.70, can I make money on the trade, Frank?
Yeah.
Yeah, you can make money on the trade. So to me, it's a good trade, but is it worth taking the trade today and going out like all this extra time? Maybe not, because let me tone this back and say, all right, well, let's just go to next week and let's see what it should cost me if I just went 1 week out. So if I go to June 7th instead, and I do the same thing, I do a 521. Let me clear this. So if I do a 521 and I do a 520, it costs me, $6.90. So it's $2 more. Let me get the debits on here too. So 521 to a 536. 536 gives me nothing. 521 to 531. Let's see. 520 to 510. Well, I could do the 508 because that's the Apple gap. I could do the 533 because that's the all-time high. Fair enough, right? So that gives me $12 of upside of the all-time highs, and that gives me $12 to the downside. That's actually a pretty symmetrical trade. So here's the good part. If I take the trade for next Friday, it's only going to cost me $6 versus $8.70. So it's obviously cheaper if I pay for less time. Now, news-wise, next week we have non-farm payroll. That's really the only major U.S. news we have, but we have other central banks moving as well. As far as coming into the FOMC and coming into the CPI data for that, I think it's the 10th through the 12th, this is probably what I'm going to do. I'm not going to take the trade today. Although if I take the trade today, it's going to cost me, $2.40 more. I still think I can make money on the trade, but I'd rather save the $2 in risk and just take it on Monday the 10th when I'm back. So that's what I'm going to do. And what I can do is also I can go from the 10th to maybe out through the out through the what? The 21st. I can go out an extra week and get myself post FOMC time. And another thing I could watch for, and I think you and I talked about this offline, if the SPY is selling off and this IV rank goes up to 20, 30, 40, I can start selling options again. Because the option selling at a higher implied volatility, you collect a lot more credit, and you can also position yourself out further. So this is all fancy option stuff, but there's essentially your standard deviation. Okay, a one standard deviation move covers about 68% of the trades. So if you want to trade a standard deviation, you're typically trading a 30 delta. Okay, so this is just fancy option stuff, but it's just math. So if I want a 68% probability of profit every single time, I would stick around that 30 delta all the time if I'm selling options. I like the 20 delta or the 15 delta, which is obviously out here. Okay, that 20 to 15 delta, which increases my probability quite a bit, because now I'm looking at like an 80 to 85% chance of profit. And if the high implied volatility, I can actually collect a decent amount of credit and take on less risk and get a higher probability of profit. So this is why I've been long options mostly through the last couple of let's say 2, 3, 4 weeks, because the IV's been so low that I'm not getting anything that I want on selling options. But if this IV goes up because the market drops and there's higher volatility, then I will go further out, do my 15, 20 deltas, and stay further away from price and be able to collect more premium because of the higher IV.
15, 20 delta for like a day out?
No. For like probably 1 or 2 weeks out, or probably like 30 to 45 days out. Like go
Wouldn't
out.
that be like 20 cents or less?
No, dude. If you look at it,
delta?
if I was going, so if I go out a week, yes, it's going to be like nothing if you go out a week or two. But if I went out, let's go out 45 days. Okay, I'll show you. Let's go out. Here's a 42. Here's a 49. Let's go out 49 days to this July expiration. If I did a, we're on the SPY. So if I do a 15, let's do a 15 delta. Okay. So I'm out 49 days. If I do a 15 delta, I can sell a 543 call for $1.50. And I could do a 15 delta on the put side for $2.35. That is a crazy amount of put skew, Frank. Look at how much they're paying us on the put side. The IV's going up. I'm getting $2.34 on the put, and I'm only getting $1.50 on the call. So where's this market leaning?
Bearish,
right? Like you're getting way more premium as an option seller to the put side. Does that mean that it's going to be assigned? Does it mean it's going to be a threatened position? I mean, where's 490 out on the SPY? if we came down to 490, I mean, would you position for that? I would. I kind of like this trade, dude. I mean, if I position at 490 and I'm positioned up here at 550 something, I mean, if price stays where it is, I make a lot of money, right? I mean, again, it's a strangle. But if I did this strangle, I can collect almost $4 of credit. Okay. Yes, I've got risk on the trade. I've got to put up about $7,800 because it's a naked trade. But if I wanted to, check this out. I can make it. And here's the good thing. I can make this way less buying power reduction by making this a spread. Okay. So if I went to the 543 by 548, and then I did the 4, what was this one? 492 to 487. I mean, now I go from collecting $3.80 to $1. But the difference is I collect $1 here and my max risk is, that's not right.
Well, if you sell a strangle, isn't that unlimited risk?
Yes. On paper, yes. Right? I mean, because if I had a naked put, it's unlimited risk to the downside. If I had a naked call, it's unlimited risk to the upside. But the reality is the puts or the calls in a strangle, you can make adjustments and you can let's say that one side, let's say that we sell off a ton and the put side is being tested. Well, I can move my call side down right away and I can collect more credit, or I can take the profit on the call side, reestablish a position. I can also, I can roll the puts out in time so it's not threatened and I collect a little bit more credit and I can defend that line in the sand. But the risk would be like, would I get assigned the SPY? I mean, I'd be okay getting assigned the SPY, right? But would I be, so here's what I have to be happy. If I do it this way with an iron condor, meaning this is a bull put spread all the way down here at 492 by 487, and this is a bear call spread all the way up here. The nice thing is I go from $8,000 in buying power to only reducing it by about 391. Now, I think the probability is, well, I could probably go higher than this. So I go 5, let me go. So that's a $12 wide. And then here to, let's go $12 wide, go 480. So now I can make almost $2 of credit. I obviously have risk in the trade if this position's threatened. But here's what I'm already in positions. I already have a ratio spread, so this is probably not something I need to double up on. I think that'd be a little silly. But as this trade stands, I mean, think about the numbers here. I would make, so I can do a naked strangle, and it's a 15 delta for $3.85 credit. Okay, it's going to cost me $8,000 in buying power, and it's going to have unlimited risk, right? So it's basically an undefined risk trade. Now, if I wanted to do a wide iron condor, I can do the 15 delta sell strikes and go $10 to $12 wide for $1.97 credit. So I want to just type it up and do the comparison. Now I take up $1,000 in buying power, and I have defined risk. Okay. So the pros and cons, if I have a naked strangle, I can roll easier and I can adjust easier to limit the risk or turn it into like a net profit. That should be pretty straightforward. And with the naked put, there's so much premium up front that the idea is you manage that halfway out. So if I'm 49 days out, I manage it at 25 or 21 days to expiration, and I take about half the profit. That's the plan. If I do the wide iron condor, it's a credit spread. I can't really roll the credit spread. If I roll the credit spread, it's going to be out in time, but I'm going to have to roll it for a debit, and that's pointless. So the strangle is a little bit more agile. The iron condor is more set in stone, but the difference is way less buying power. You're still collecting a decent premium. I mean, $2 versus $3.85, but you're looking at essentially the same trade. You know, it's just, if you can't afford to take an undefined risk trade, then obviously don't take it. But the probability is still the same. If I take this trade right here, either way, you're looking at about an 80 to 85% chance of profit. It's just, how do you have a plan B to manage it? The strangle, you can have a plan B, plan C, plan D to manage it. The iron condor, not so much. You're pretty much set with that trade. That being said, though, you can make money on the bear call side, but the bull put spread, I might actually consider taking assignment. Because if I did the 492 by 480. I'm collecting $1 there. I could actually take assignment, own it around 491 if I wanted to. And if I look at the price, that's not a bad spot. So long story short, just bring this summary, and hopefully this isn't like over anybody's head here. I like the trade. The only reason I'm not taking this trade right now, Frank, is because I'm already in it. I'm already in a version of this with the ratio spread. I already tied up that kind of undefined risk trade with a ratio spread, and it's right here. I'm selling the 482 and I'm buying the 487, and because of that, well, actually no, I already have the iron condor right here, the 487 by 482, and oops, whoa, what's up? And then over here I have the 550 by 550. So I already have an iron condor on this, and it's $5 wide. So that's where I'm currently sitting in a lot of these trades.
I have a question for you.
Yes, sir.
How much time do you have? Because I was wanting to talk about another earnings week.
Okay,
and
let's do it. Let me do one thing. I've got time, dude. I mean, Gary and Donna and Linda, some of my equities on demand traders, you good? Just let me run a little bit longer. Usually I have equities on demand at like 11 o'clock or just after. Let's talk earnings. We'll chat. Yeah.
If not, we can just do this Monday, but
I'm not going to be here Monday, dude. I'm out.
Oh, yeah, that's right.
So let's do it now. We'll take it every time we need. Chandler, if we're good on time, I'll keep going. Yep. Gary's good. I think we're fine. So let me do this really quickly. I want to post my Discord. If anybody'd like to join my Discord channel, it's right here. My Discord channel. Okay, so I'm posting that in the chat. If you join my Discord channel, really simple. Use the free group chat. That's the best place to find me every single day. I'm throwing this out there from moment one. If you join my Discord channel and all of a sudden you receive a direct message from some similar but not the same name as real Chris Pulver, it's not me. I hate the fact that I have all these scammers. Frank, Nick, I'm sure you guys deal with it a lot at A1 Trading, but the best place to find me is right here on my Discord channel on the free group chat. Everybody can post. I'm on this thing every single day. This is where you find me. This is me. I don't see any scammers and imposters on my actual chat. They're all in the direct messaging space. So you've been warned. I hate the fact that I have to say this every single time. But anyway, that's where you find me, is my free group chat if you join the channel. So, all right, dude. What do you want to talk about? What's the earnings play? You always come up with good ones. And Frank, I owe you something, dude. You hooked me up with CRM this week, and that was a great one. So thank you for that.
Oh, yeah, no worries. It was a mutual beneficial event.
Sure.
We got Tuesday CrowdStrike.
Okay.
And then we have Lululemon on Wednesday.
Ooh, Lulu. How many pair of Lulu pants do you have?
Not enough, dude.
Not enough. Oh man. I have never worn a single pair of Lululemon pants.
I didn't know you were serious. I thought it was for women. Was it not women's clothing?
I mean, they have shoes now, man. They have some nice stuff, but it's like, why would I pay $150 for a pair of stretchy? Look, if anybody was around in the 70s, I wasn't born then, but I did have some awesome leisure suit, like high school throwback parties or whatever. It's like I rocked some leisure suit pants back in the day just for fun. It's what Lululemon is now. They're just like, it's like polyester and spandex, and they're $150 khakis. You got to be kidding me. And then now there's a bunch of imposters doing the same thing. It's like, oh, you like this? Well, here's Bird Dog, and here's this, and they're all the same garbage, which like, we can stretch our pants, and there's $150. It's like unbelievable. So no, yeah, I don't own any.
Not really my thing.
Yeah.
Especially when I can go to like TJ Maxx and get something similar for a lot less.
Yep.
But
well, hey, I'll throw the brand out there. It's on Amazon. It's CRZ Yoga. It's the same freaking pant for $40. So that's my.
You said CRZ Yoga?
CRZ Yoga. So
I don't think I've ever worn yoga pants either.
They're not yoga pants, dude. They're khakis, but there's the same stretch material. So that's my golf attire. So Drew, James, check it out if you guys want some stretchy pants and not overpay for them. Frank, you got to look good on the golf course. You get hooked up with some clubs,
I do. Yeah, you're right.
All right. Anyway, all right. CrowdStrike 312. I had a strangle on this not too long ago. I can see that right there. It's still in that same range. Is this next week, by the way?
It is. It's on Tuesday.
Tuesday. Okay, Tuesday after market. All right, let's take a look at the numbers. So option slam. Okay, so we're going to go CRWD and LULU. So crowd strike here. Pretty decent. So the average is 13.71. I don't love that we had single digits prior to that, like back in 2022. But we do have some consistency in the double digits. So 13, 11, 12, 12 and a half, 10, 13.7. I will be a little bit more conservative on this and say, how about we do like an 11 to 11.5 for my calculated expected move? Because, you got single digits here. You got 11 and change here. I'm going to go, we'll do both. I'll give it a kind of a bracketed range. So I'm going to say 11.5 is going to be what I would calculate the move to be. So we'll go 11.5%, and then we'll do a 13 point. I'll do the average too, but I think that's going to be in the high side. And then we'll look at the weekly. We'll also look at the weekly trading range.
I guess since it's Tuesday, you'd want to go out till like the 14th or something.
Possibly. Well, what we can tell is let's go to this. Let's go to this piece right here and see how often does it get to that 11.5 or 13.71 immediately after earnings. Because if it's Tuesday after market, you've got Wednesday, Thursday, Friday. So if you hit those right out of the gates, you hit 3 days. If it's day one and it hits it, you might see that big reaction and you can close it out. But to be safe, you're right. You probably go out to the 14th to be safe. You're just going to pay more for the option. So, all right, let's check this one out. So if I went out to, let's go out to 8 days. That's typically how I calculate this. So day one, we hit it. This one is 10.68 to 12.75 after 8 days. It's there. 10.68 is not quite 11.5. So let's make sure that let's say 10% to be like super conservative. I'll put this back over here. We'll say as long as we get a 10% move, okay, then I can count that one as a good one. So 10%, that's really conservative. Okay. So how many times did we hit at least 10%? Or ideally we're shooting for the 11.5 to 13.71. So let's keep going. And this one would hit within day two if we're just going after 10% move. This one, 11.7 hits day 8. That's my least favorite, man. I hate it when it does that day 8, but this one's only 8%. I'm not going to count this one. Okay, but we do get there day 8. I just don't want to wait that long. And then this one, 8.37, and we don't get there. This one, 6.36, that flips to negative. That's actually a 10% swing, but unfortunately, we don't go one direction, the 10 to 11% we want, so that one doesn't get there. This one gets there. This one at 10.78 gets there day 3 and 5. That one's okay. That's actually a 15% swing to the downside. This one does not get there. This one gets there. And this one does not get there. So similar with a lot of options, we have 1, 2, 3, 4, 5. We have 5 and 5. Okay.
Also, CrowdStrike is moving very heavily from yesterday and today. And it seems like the volatility's already starting.
CRWD. Yeah, there it is. So the IV is 79.3. If I go out to the 14th, the implied expected move, 37.73. Let's crunch the numbers on our 10%. Okay, so the IV is a little bit higher, which means we're trading now. So the weekly average is 27.47. This has had two big days rather. Yeah, 2 big days to the downside. Let's go 10%. So if we're trading at 310 going into next week, 310 at 10%, you're looking at a $31 move. The IV is a little bit higher. So actually, Tasty has it expected to move. This is out 2 weeks, by the way. But Tasty's expecting to move by about $38, just shy of $38 by the 14th. I think we can position for that. It's going to be a fairly expensive trade if we did, near the money, if we did like the little reverse iron condor kind of breakout trade, or we can do some credit spreads because this one probably has enough juice to go somewhere to like test this high or test this low. Here's what I'd have to look at. The downside right here at 273, that's $40 away. I like that trade right there. To make this inexpensive, I would consider the credit spread and just do a deep in the money bear call spread. and try to collect. Let's see what it's going to cost me. It's not going to cost me anything. Let's see what I can get for the trade. So there's two ways we can price it.
What price was that at?
That low right here was around
275.
Yep. So about 280 to 275. That's $30 away to get to this low and to hit that wick low and fill this gap is 265. That'd be a $45 move.
So it's like a $3 something credit spread.
Are they 250 apart?
They're 5 apart.
Oh, they're 5. Yeah. So if you could collect like 350 to 375 on that bear call spread, I'd be okay with that. So if I did the 275, this low is 280, 27. So let's just do the numbers. If we did $30, so if we did $30 off this trade or $35 off the trade at 280 by 285, I could get 340 or if I get 350 out of this trade, that's a very doable credit spread, right? If we started here, let me change the color here. If we started here and we go to the downside, then that is $30, and we're looking at a $37 to $38 move. If we exceed that and all of a sudden we blow $40, $50, then you collect your 340. Your risk is $1.60. That's a pretty favorable setup, and it's also cost effective. You're going after a bigger reward than risk, and you don't have to hold it all the way to expiration. But if this 340 credit turned into 240 or $2 debit, just take the profit. But that's a good chunk of premium to collect because of the higher IB.
Yeah.
Jay says, "How legit is this Chris guy?" I don't know, Jay. You be the judge. All right.
That's funny.
Okay, so if I did a bear call spread, that's what I would position. I do a 280 by 285. If I did a bull put spread just to play it neutral in case it was a big pop to the upside, we go back to the highs. Highs around 360. That's $50 away. We obviously don't need a position for that. But if we did let's go $30 higher. So we go 340, and let's make it equal. So we have $5 here. Let's go $5 here. So for a $10 max risk, I could get $6. I just saw 7 a second ago. If I could take this trade right here, Frank, and get like 750, 725 to 750, I'd be pretty happy to take that trade. So that's what I'd look for is I'd essentially say, I'm going to go $30 this way. I'm going to go $30 this way. I'm going to position within the money credit spreads. If I can get, let's say 725 or better, then that means my max risk is 275. And I doubt we're going to risk that whole amount because that means we're waiting to expiration, which we're unlikely going to do. So I would say that'd be my position if I could take it, would be 725 or better credit. If you wanted to go better, okay, if you wanted to go better credit, you got to go deeper. So I'd have to go 275 by 280. I'd have to go 340, 250 by 337. Now I get my 750.
But
how much space is that? That's what, 275. That's $35 now, which is essentially the entire move. So that's the tough one. That's the tough one.
Look at the open interest though. It's very small.
Okay. So
trying to close out.
Yeah, that's a good
profit.
Point. That's a good point. Let me see if I get open interest on here. Display expected move, order stocks options, order stocks. What do you see for open interest?
So at 335,
yep,
it's 85, which is not amazing.
Okay, anything over 100. If you're looking for open interest, anything over 100 for open interest is decent. That's liquid enough. But 85's it's close. It's not 100.
340 is 39.
Yeah. Well, it all changes if price goes to that point, right? Like it's a liquid stock. And here's what we have to know. How many average shares does CrowdStrike trade, right? Volume's 2.06 million. This is on today. It's like we're averaging over 1 million shares. It's pretty liquid. The open interest, what that shows is that's where everyone's positioned right now. Right. So, it's an area that going out to those certain expirations and strike prices, those are all out of the money. But a lot of open interest is for people that are long options to see, like, are they going to get in the money?
Yeah, but if it moves heavily one way, say it goes up, then you're your credit spread on the downside, those calls are going to be like zero open interest.
Yeah. Well, I look at it this way. Based on the numbers, based on the process, based on it's a 5 out of 10 shot, right? It's a 50-50 for, it says it hit expectations. And if it hits expectations, it's at least a $30 move. That's being conservative. It's a $31 move. The IV is higher on CrowdStrike because of the recent sell-off. That's a $37 move. I think if we position for, and here, look, if you want the best bang for your buck, then you're long at 315 and you're long at 305. That's going to be your best position as far as the fairest shake of making money. The problem is that's a crazy expensive trade. Now, for a $36 move, I'm paying $36 for a debit. That sucks. And I'm also giving myself about a $5 head start, which is not good either. So I'm actually overpaying for the long option, which means I'd have to pair that with a sell trade. So if I did, let's go up $40 here, Frank. Let's go 345, or I'm sorry, 355. So I'll go up $40, and then I'll go down $40 to 265. So I can turn what should be a probably a $31 to $35 move if we have an expected move, and I'm going to pay $25 for it. So are you willing to pay $25 for the likelihood of closing out for 30? You'll make
not really.
Right. Look, the probability is high that you can make some profit on it, but you're not going to make a killing on it. And you're also going to be putting out way more money than you're taking in. So if I'm wrong on the trade, I risk a lot of money up front. If I'm right in the trade, I'll make a quick $300, $400, $500 and be happy. But what you're relying on is a better than expected move. And this is always the trade-off with like selling options versus buying options. If you're buying options, oftentimes the market makes you pay for it. You're paying for that premium. If you're selling options, great. But if you're selling on the outskirts, if you're selling thinking like, oh, it can't go higher, can't go lower, that is a very dangerous game. Because what we just saw this week is it certainly can go higher or lower. And that's not good, because if you're doing especially undefined trades, you're always scrambling to fix those trades and repair those trades. And that's a lot of extra work. So anyway, this is cost effective. I'm sorry, this is a fair way to trade it. I think this is a probability that, if I want to fork over $2,500, I do it. I think the probability of making $400 to $500 is fair. I like high probability, but I don't want to fork over that for a trade like this. So I would probably do what I said and do the credit spread route, go up $30 or maybe $35 and just see if we have, let's go up $35. And if we get filled, this would be, I said 725 or 750. It's a very small risk trade. So 310, we're trading at 310. 310, let's go up $35. So I'd go to 345. And because the put side only has $5 strikes, I'll do this. I can get $4. Maybe I can, maybe I can't. But that's a nice chunk of premium where I risk very little money compared to what I can bring in. So if CrowdStrike blows through earnings to the upside, that pays very, very well. And we don't have to wait to expiration, but that'd be the trade. To the downside, let's go $40, right? Or I say, $35. So $35 from 310, we should be sitting around 375 or 275, sorry. 275 to 280. That's the trade that I would take. Would be a 750 to 760 credit. And if we have a big move one way or the other, so here's how you know it's a good trade. If price goes down here, we can get paid on the bear put side. If price comes even close to this high, we get paid on the bull call or the bull put side. This is the bull put, sorry. Bull put on the upside and then bear call on the downside. They're deep in the money credit spreads. Price just has to move, right? So, it's a trade, and I'd be way more comfortable saying if I'm right, I can make, $200, $300, $400, $500, $700 on the trade if I want to hold it to expiration. Immediately after earnings, if we're up near this level or we're up near this level, strike price wise, we could still take a 7-something credit and turn it into like $1, $2 wins. Like I did it on Meta, I did it on Netflix, I did it on Nvidia. I've done it on all these very expensive options where I don't want to pay $3,000, $4,000 to get in the trade. So instead, I just collect the credit and give the market a chance to move, and it does. It exceeds expectations, and all of a sudden, I make $100 or $200 with way less risk. So I like this trade. I know you're looking to open interest, but that wouldn't concern me for this trade, because if we are seeing price up to 345 or higher, shouldn't be a problem to get out of that trade at least a debit less than what you paid, or less than what you collected.
So in the same sense, looking at Lululemon, they're the same price right now.
Okay.
I see higher open interest, and I'm looking at a 345 by 350 credit spread. I guess that would be called a bull put spread.
Yep, you're correct.
So
345 by 3. You said, so what's the sell side? You selling the 350 and buying the 345?
yes.
Okay. So you're looking at a 350 by 345.
And it's a credit of 415.
Did you get filled on that?
No, not
Okay.
yet.
Okay. I was like,
I'm-
dude,
I'm
that's
looking at it.
insane.
It
Let's
would
see
be
how
nice.
All right, let's see how far in the money that is, and let's see what the price is actually expected to do, because that might be great going out a certain amount of time, but if price, I'll say this, if price drops, this has a chance to get assigned, which I know you told me before you don't like to get assigned because it kind of it fudges up your margin. All of a sudden you're getting some slaps on the wrist from Webull, right?
Yeah.
All right, so let's take a look at Lulu. All right. So CrowdStrike, I like that credit spread approach as opposed to the debit. Let's go Lulu. And we're looking at an average move around 12.43. Again, I see single digits and I see some double digits, but it's 10, 11, 14, 13, 11, and 12. I'll probably split the difference and say from a 10 to 14, I'd say we go like 12%, just like maybe 11 to 12% is expected. So price wise, 11 to 12% on a 312 stock. So let's go 11%. 11% times the 312.62. That's a $34 move. The average weekly move is around $27.50. That's no catalyst there, no earnings, but $34 to upwards of, I'll go $12, and anything beyond that is great. 0.12 times 312.62. So we're looking at about 30, roughly like $32 to $37. So on the high side, $37.50 if we hit that 12 and change. If we go 11% again, so 37 versus, so $34 to $37 would be kind of my window as far as trading it. Let's look at the IV. This is probably high as well because it has been selling off. IV's 85, which means as an option seller, pretty good opportunity there. When is earnings? Probably similar timeline. The 5th aftermarket. Okay. So I go out to the 7th. And okay, so the good and the bad. On the put side, you got a bunch of $2.50 spreads. On the call side, you got a bunch of $5 spreads. So we want to make sure they're even and symmetrical. We're looking at about a $34 to $37 move. So we're trading at 312. Let's go up 30. Let's go up $30 and see what we can get because we have higher volatility. So let's go $30 up and do a 345. I can collect more premium here. I did a 345 by 340. That's the one you're looking. You looked at the 350 by 345. I think this one is fine, Frank, because the IB is 85. I would consider the 345 by 340. It still shows me you get $4 credit on that one. That's an incredible fill. That's a super low risk. Obviously, I think that's fair because we're looking at about a 32 to 30, $34 to $37 move. So that's, if we hit the expected move, this pays. I think 350 is a little bit too high, especially if you're only getting like 410, 415. I don't think you're going to get that either. And the reality is, for a $5 spread, I think I've very seldom have I collected over $4 credit on a $5 spread. So if I get 375, I take that trade. If I get $4, I would absolutely take that trade. This is probably the way that I would calculate it based on what I see with the expected earnings.
So like 380 is a good, that is the majority of the spread, right?
Do the math. If we collected 375 out of a $5 spread anything over, if you're going in the money and you can get 70 to 75% of the premium on that spread, that's a great fill. So 370, 375 is a great fill out of a $5 spread. Anything 70+%. I'm happy with that. So I think that's a good trade. Obviously, if it's 380, 385, 390, that's awesome. But that's a very good fill. That's super small risk. So that is what I would do on the bull put side. So I'd sell the 345 put, buy the 340, try to collect as much premium as you can. Looks like we're going to get somewhere between like 375 and 385. On the downside, let's go $35 here. This one gets a little bit trickier. 312 and 35 should put me at like 270 something. 277. So I could do, so is this $5? Yep, that's $5. So if I did the 275 by 280, I mean, again, same thing we looked at on CrowdStrike. If I could get 750, 775, 780 to put these together and get filled, that's a really good trade. Again, very low risk for high reward. Now, you have to remember here, so anyone that's watching this, you know, there's going to be a losing trade here, right? So when I take these trades, if I did this trade right here, I just want to explain how this all works, right? So if I do 2 credit spreads and it's deep in the money, I plan to win 1 and lose 1 because directionally this is an earnings play. Price is going to go somewhere. But the idea is my winner is way bigger than the loser. And so because we could collect, let's say we can collect, you know, $7.50 credit, that means our $2.50 is our risk, and that's our max risk. So the probability play is for the 750 credit to be monitored and closed at a lesser debit. So the way I take these trades is if I'm filled at 750 credit, if I see 650 debit, that's $1 net profit, right? If I see 550 debit, that's $2 net profit. From a percentage basis, that's still the same win that I'd like to take in any other earnings play. So if I say
Lulu's expected move was 30 something points,
it's like $34 to $37. Yeah, based on an 11 or 12% move. So here's one last thing we have to do on Lulu before we're done. So really quickly, does that make sense, everybody? So I don't expect to win the full 750. Okay, what I expect is if price makes a move with earnings one way or the other, and it starts to push through one of my credit spreads, that means that credit spread has a lot more premium to collect up front, which means I lose on the other one a very small amount, and I can have a debit that allows me to make net profit. So if I collected 750 up front and I see this trading for 650, 550, 450, I can collect that net profit. And as a percentage, if I did $1, okay, if I did $1 profit, okay, $1 profit out of what's going to cost me a max, if I lose, I'm risking $2.50. So if I make $100 out of a max risk of $250, I'm making 40% on that trade. So you have to make a lot of money. It's just, can I consistently and routinely make profit? And if I can, that's a good trade. So anyway, that's what I'm doing. So let's talk one last thing on Lulu, because we have to see how many times has it hit that 11 to 12% post earnings move. So let's find out. So we're looking for 11 to 12%. 11 to 12%. I'll cut it off right there. That's hit. That is not. That is not. That is. That is. That is. That's right at it. It gets there 5 days later. That is. That is not. 9.57. That is not. That is not. 5 for 5. That's so, you know, does this mean I shouldn't take the trade? No, it means that if I take the trade, am I willing to risk $225, $250 max risk for a trade that can, with a decent probability, with an expected move, can it make me $1 or $2 net profit out of a, you know, $2 risk? Probably. That's all I'm going after. You know, so what you're looking for with these trades is, do you believe that there's an earnings catalyst that is big enough to push Lululemon, good or bad? I don't know. I mean, they could come out with flawless earnings and the market could be selling off all week and Lulu is going to drop. It doesn't really matter what the earnings does. We've seen it. Like Costco. You said Costco beat top and bottom expectations today, right?
Yeah.
Yeah. So, okay, but it's down. That's what earnings can do. It doesn't have to make sense. All I'm doing is I'm following my formula here. This is, I know what the expected move is, how many times we hit the expected move, and this is why I'm not going to pay for Lululemon. I'm going to collect the credit and see if it does go the expected move. I'll just collect the premium and I'll just take, instead of my max profit, I'll take a little bit less, but I'll still walk away net profit. So
is there a way you could say you sell out before earnings, but your credit spreads are lower?
are you saying tighter to price?
Like, okay, so say your credit is like 380, and then you see it the day before earnings, it's at like 290.
I doubt it. It's not going to happen. There's too much implied volatility going into earnings to have it be. You won't have the IV contraction. It won't happen. You'll have swelled IV.
I'm in a credit spread on Costco, and yesterday when I entered, I was up like a pretty good amount, but it would be a day trade if I closed it out. So I kept it, but both sides were significantly less than what I had entered. So
interesting. That's interesting because was there a big move prior to that?
No.
Okay. I mean, that's not really, I mean, honestly, for an $800 stock, that's not doing a whole lot, man. And that's fine. I mean, I've got a broken wing butterfly at 750, so I don't really want the stock to do anything other than keep going up. But the broken wing actually gives me my perfect little, tent price if I get paid on it. But that's how I think that's a June expiration. So, I mean, so you say that, and I wonder if you were to try to close it, would you have the right fills and the right spread to close it? I feel like that spread would be wide enough that you may not have gotten filled the way you wanted to, maybe. But if you just looked at the mid price and it was less than what you got filled for it, but usually, like I said, you don't see that because you have this IV swell going into earnings, and that usually doesn't like you can't pop the balloon until earnings is done, right? Look at Abercrombie and Fitch. By the way, I said I want to fade it. Should have faded it, bro. But so you had this big IV swell, you had this big blow off expected move, and then now the market turns normal, which is okay. There's your reaction, and then if you're just fading that move and just having price kind of come back to normal, that would have been a more aggressive trade. But I didn't take the trade. It is what it is. So anyway, Lululemon, CrowdStrike, that's the way I trade them because they're both $300 stocks. I think it's a little bit expensive to throw out $2,000 or $3,000 in the debit side. So I would just do the in the money credit spreads and try to make. I mean, you get $7 of credit, $7.50 of credit. See if you can close it out for like $1, $1.50, $2 net profit. I think that's a great trade, and it's also very cost effective. You don't have to wait for expiration, but you can if you wanted to. The good thing about those trades is time's on your side because your credit spread. The issue, like in your account, Frank, the issue would be if it's a big move and you're in the money, there runs the risk of that potential assignment. That's the only risk that you would have on the deep in the money credit spreads. So on my side, they don't assign me and close it. It's like I get assigned and I always have a day or two to manage it. So if I get assigned, I would just close it out, neutralize the position, take the very small loss because I'm taking about 70 to 75% of the premium up front. So I wouldn't take a huge hit, and then I'd see if the other one pays out. So just numbers, I mean, if we collected $7.50 to $8 up front, we're trying to, close it for less than that and just have a probability profit. Just a trick. But those are good ones, man. Those are good. So real quick before we go, and I know we've gone long today, dude. I've had a blast. This has been fun hosting for a solid, 2.5 hour stream. Let's call this the A1 Trading Marathon. Let's go stock Twit's calendar.
How do you feel streaming for 2 hours this morning?
I'm going to do another live session right after this. So I'm just getting settled in. It's fine, dude. I do this every day. All right. I mean, look, the nice thing is I talk out loud and I'm just thinking through my trades. So over the course of doing this for, 10 years in the financial education space and talking to all these traders, it's like all I'm doing is thinking out loud. And if you ask questions, I try to answer them. I'm trying to help people learn. It's like, this just helps me be more transparent. This helps me be, like I think through all the pros and cons of my trades where I have to justify why I trade, and it's like, I'm doing it to myself and I'm talking. I mean, I'm not a crazy person. I'm not just talking out loud when I'm not talking in a live session, but believe me, like it helps to talk through this stuff. It helps to go through the entire strategy from start to finish before I ever place a trade. So, and having you on, and it's like, it's great, man. We can kick these ideas around. And I mean, if it wasn't for you, I would not have taken CRM this week. I wouldn't have taken Alta this week. And both of those turned out to be profitable. Alta was a break even, which I'm happy with. It's fine. Better than, that's a crazy reaction, by the way, to go up $40 and drop literally the same day. Psycho Alta. That's a rough trade, dude. I'm sorry that, to have it blow up the levels that you needed to and not get filled to take your profit. That is really crappy, but I will be cheering it on to see if now there's enough juice in this move to go somewhere else and get you, one side or the other to pay you. So what I want to look at was for next week. I mean, again, very light in the earnings space. In fact, I see very little of these stocks that I'm even interested in. The notables we just mentioned, CrowdStrike and Lulu are not here in the notables, but we only have, I mean, this might be under 100 stocks. It's going to be close. So we have 7, 15, 28, 33, and 2. Yeah, dude, 85 stocks next week. That's a very light earnings calendar. This is why I also wouldn't necessarily do a lot of June 7th expirations. I would probably do the June 14th because you have another catalyst outside of just earnings. You have non-farm payroll on Friday the 7th, but the following week you have U.S. data, inflation, CPI, plus FOMC. So I think just in and of itself, you've got earnings. Sure, that's going to matter for the immediate move, but there's going to be some extra follow through one way or the other. There's going to be some volatility coming into that June 14th cycle. So that's where I'd be looking for a lot of these earnings plays. Just get out there, get enough time to take the trades out to June 14th and get that volatility. You and I will come back and revisit this. Like I said, I'm out of town and no live sessions for me next week. But when I come back on the 10th, I'm going to trade probably out to the 21st and do just a SPY, a diamonds, a Qs, an IWM, and just do an expansion play looking for some type of movement through June. Again, we'll price it out, see if it's worthwhile. Maybe the market wants to go somewhere. Maybe it doesn't. I mean, at the end of the day, it's summer trading. Volume's been lower. The one thing I need to look at is this. If we're still talking about the SPY or any of these indexes for the Qs, the DIA, whatever, if it's not 20 or higher, I'm probably going to favor buying the options. I mean, this went from 2 to 18. That's a bit of a volatility swell, but not much. I mean, it's because prices slid a little bit. Like we're at fresh lows today, which means I'm obviously forfeiting those profits again. I'm going to look back in hindsight and slap myself in the face. But right now, my $1.20 debit is now trading for $3.30 credit. So that's a $2 net profit per contract. That's why I said if I just move the stop loss to break even or better and just monitor it for the day, we're coming down to the gamma levels that I talked about this morning, right? This was my first target at 520, 519. We're at one of them. That's all I need, man. I'd be stoked if I was just closing it right now at $3 and change. But it didn't. So I'll take my profit, dude. I'm not unhappy. I still made 90 to 90 cents to $1 per contract. But anyway, this is what's nice to have a visual roadmap. I expected it to move this way. It did. And I don't make this stuff up. So cool. Hey man, any other questions? That's fun.
No, I guess I'll just keep looking at next week's calendar and see what else we could conjure up for earnings plays. But other than that, no,
Okay.
I think I'm good.
All right. Well, I'm going to live vicariously through you and have a European trip. I think that's the plan. It's either Germany, Iceland, Switzerland. That's the plan. So we'll catch up.
You haven't decided yet?
We haven't decided yet because we have to look at flights. We're trying to get to Chicago tomorrow, and then that's going to be our main hub to see where we can go. So it's
why are you trying to fly out over here? Why don't you just
know.
take a direct flight?
Because I don't have to pay for it.
Oh yeah, what am I thinking? You're in Utah. I was like, why don't you just fly from Hartsfield? But obviously, and what is it like 5 a.m. there or something? How early is it?
I mean, it's 9:30 right now. It's like I start my day at like 5:30, 6 o'clock every day.
So you started streaming at like 6, right?
Yeah, it was so for a 9 o'clock stream, it was 7 a.m. my time. But every day I usually start at 6:30 or 7 o'clock.
That's tough.
Yeah. But the closing bell's 2 o'clock. So I've got the rest of the day, and sometimes that includes a power nap.
That is true.
Yeah. So, all right. I'm good for right now, man. That was a blast. Chandler, team, thanks for having me. Everyone listening, thanks for being here. I wouldn't have the luxury of doing this or the privilege of doing this without A1 Trading. So big thanks to them. And happy Friday. I'll be gone for the next week. I know you'll be in great hands with all the guests that are filling in. Frank, you gonna run some sessions solo next week?
Probably not.
Probably not. Oh, come on, dude. I want to tune into that.
I do it with someone, but I'm not a good host. I listen more than I talk, so it'll just be a lot of silence if it's just me.
It doesn't have to be awkward. It's like just focus on the process. All right. No more rambling. I'll let you go. Happy Friday, everybody. Have a great rest of the trading day. Frank, thanks for doing this with me. That was fun.
Thank you, Chris. Have fun in Europe, wherever you end up.
Thanks. See you, everybody. Take care.
Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to share free value to you, our audience, through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more, lest ye walk the plank. Join our crew as we head out to go long on gold. See you next time.